not one-off. We are going to spend on talking about what value we have been delivering for decades, and we haven't done that talking adequately enough. So that's what that's where these expenses will continue to be at that level, if not grow further. And when the revenues come, the margins would be back where we are expecting them to be.
Mr. Dasad, we wish you all the best for that and more. Thank you so much for joining us and giving us the perspective. Really appreciate your time. All the best for the quarters ahead.
Thank you. Thank you very much.
We should pull up Nuclear Software and see how that one is doing in trade this morning. Remember, the markets are also skittish. For now, flat. Let's wait and watch how it shapes up during the course of the day. But a clutch of other names, not too many large names that are out with results, but a clutch of very interesting names, the likes of Ashoka Buildcon, KNR Constructions, and all of that would be in focus in the session today. 11% odd for Ashoka Buildcon seemingly, 17% odd for KNR Construction seemingly. Sula Vineyards could be taking a stick lower, PNC Infratech could be taking a stick lower, and BSC could actually be doing okay. So those are the names that you want to work with. But you also want to work with stock ideas. BSC is up 4% and not unexpected, by the way. PNB Housing deal around 961, not bad actually in terms of a reaction. But let's get the stock ideas out of the way first. Kush, I'll come to you. Your top recommendations for the morning.
A long and a short. On the long side, you've got Ganesha Ecosphere, and this stock has rebounded quite smartly. If you see, there is a mild bit of a resistance around the 2380 mark. So that's the first target. But once that is taken out, you're also looking at a 2480 kind of an upside. 2200 becomes your stop loss. On the short side, you've got ONGC. Was mildly negative for the last couple of sessions, but yesterday it's broken that support zone of 250 255 or rather 259 on the back of very strong volumes. Could see lower levels of 251 245, and the stop loss here is 262.
Okay, so those are Kush Bora's call. A couple of calls, a buy and a sell. Interestingly, Ganesha Ecosphere comes in after a while. Chandan, what would your recommendations be for this morning?
So yes, I'll go with one buy and one sell. Buy trade is buy on Ramco Cement. The stock has given a consolidation breakout of last couple of days. Really do well on the last trading session when market was falling down. Major trend is positive. It has been moving in a rising channel. We have seen a surge in trading volume with negation in lower top, lower bottom. So expecting further up move, one can buy with support of 885, and Ramco Cement can head towards 970 level. Second trading area, there is sell on Godrej CP, Godrej Consumer Product. Structure is continuously weak, has been making lower top, lower bottom from last almost 9 to 10 weeks, corrected from 1540 to 1170 kind of level. Weakness could continue. Stock is trading at multiple months low level. So till it holds below 1200, one can sell for a downside target towards 1125.
Okay. So those are some ideas to watch out for. Interestingly, Ramco Cement, Citi has a note today as well, so watch out for that. Very quickly, just want to mark this and maybe take a question with Mayuresh on that, but the inflation print that came out, just very quickly mark what happened. So Samina spoke about it earlier on, but here's what's happened, right? The October CPI has sizzled, but there is a moderation likely in the month of November. So what happened to inflation numbers? Inflation surged above estimates, driven by the volatile vegetable prices. And core inflation maintained the gradual upward trend, but thankfully remained contained. However, what this has done, and I think the Barclays view kind of puts this into perspective. Barclays says that we expect food inflation to moderate in November. However, 6% plus print today, which is yesterday, and a likely 5% plus print in November raises risk to the December cut call. So, I mean, I would say that they are being kind when they are saying that it raises risk to a December cut call. It almost seems a foregone conclusion that there will not be a rate cut in the month of December.
No, and I don't think it's happening in Feb either. So that's the other concern. And of course, there was, I think you brought this up, where you said Morgan Stanley expects government spending to go up in this in the coming quarter. And in fact, on that note, right, and this is why I think inflation will not ease off. I was talking to a couple of corporates, and of course this was off camera, and they did indicate that the government has written to a lot of corporates asking them to outline the private capex over the next 3 to 6 months, quantifying it and putting it down in terms of a written response. So if those two things are happening, then it's pretty certain that inflation will become a concern, and no rate cut is coming anytime soon. And our rupee has been declining. That's the other big problem. So lots of moving parts, slowing demand just being one of the others. Chandan, I'll come back to you to talk about a few more stocks that we're catching our radar. But Macquarie has initiated coverage on 4 stocks across the power, lender, and electric utility space. Mika is joining by with more on this. Mika, take it away.
So Macquarie has actually initiated coverage on PFC, REC, Power Grid and NTPC. Let's first talk about the power financiers, that's PFC and REC. The implied upside for PFC stands at 31% at a target of 630 rupees, while that for REC is at 25%. Now what Macquarie is saying that the growth momentum looks much better right now than previous cycles. They're seeing improving loan growth, sustainable returns, credible return ratios, and a diversification of the power book towards renewables implies lower credit risk and cheaper valuations. And in the power, in the utility space, well, NTPC's target stands at 475 rupees with a potential upside of 21%, while that for Power Grid stands at 380, potential upside at 15%. Now, what Macquarie is saying in this space, they see a rebound in Capex in power generation as well as transmission networks, and a key sector overhang has been reduced due to better power distribution utility health. They also mentioned that power demand supply now, the balance now is in favor of the suppliers, and key sector catalysts include higher data center demand, higher EV penetration going forward, as well as weather pattern.
So some 3-4 names, and the upsides for PFC, REC look interesting. I think PFC numbers came in, they looked solid, and the stock had reacted duly. Mayuresh Joshi, can I ask you to comment on PFC, REC? Power financing seems to be very, very strong. Are these stocks, while there is a concern on financials by and large, could PFC, REC buck the trend? Are you a buyer here? Why or why not?
Morning, Neeraj. There is a strong possibility, because if you probably look at the tailwinds that the entire sector is going through, I think there is a tremendous amount of growth that can probably come through. Case in point, renewables expected to go up from 185 gigawatts to 500 gigawatts over the next 8 to 10 years. We're probably looking at transmission lines being laid to the extent of 2 lakh circuit kilometers. And therefore, I think as the entire ecosystem evolves over the next few years, as Capex has started happening across the entire power ecosystem, right from development, that is developers, to transmission, to the EPC players, I think financiers will play a huge role in terms of supporting this entire ecosystem. Now, a large part of their lending probably goes to government entities where the risk of default remains very, very minimal. What we've also seen in the past in terms of executable timelines for most of these large projects as are concerned seems to be on track. So I think the government has put in a timeline in terms of completing these projects. And therefore, I think the working capital constraints should largely get contained as well, which is getting reflected through numbers as well. And therefore, a base case scenario becomes that the earnings should continue to grow at a very steady pace. So one can very well argue, Neeraj, that valuations are through the roof as we speak. But if earnings are expected to sustain compared to the rest of the pack, as far as the overall markets are concerned, maybe those premium valuations sustain along with the dividend yields that they probably get out. So yeah, the momentum can very well continue. Anybody holding these stocks can continue.
Right. Chandan, a couple of stocks that will be movers today on back of earnings. BSC, Ashok Bilcon and KNR. Can you share your view with us on these counters? Because a gap up cannot be ruled out. Despite that, do they still look good on the charts?
So yes, very positive on most of the capital market name. In fact, even after the market pressure, most of these stocks are doing well. We have positive view, and we believe that even if market recovers, then momentum will be more in these names. So in capital market, whether you talk about exchanges, depository, broking houses, and AMC, positive stance in all. So BSC will be my preferred pick, which we are continuously recommending from last couple of days. With support of 4,600, we are expecting the run up towards 4,950 to 5,000 in the BSC. Talking about KNR construction, it seems that bottom out process is visible in the chart setup after the decline of last 15 weeks. The way it has taken support at 280, now some buying interest could emerge. So with rising support at 285 or 290, one can look for an upside target towards 330 in the counter.
Chandan, anything on IT stocks? TCS has been lagging behind some of its IT peers in the last 5 to 6 days. even though I'm assuming today should be a quiet day largely because Wall Street has seen some profit taking. But do you agree? Do you have a consensus on that? Would you look at buying any of the IT stocks today, or you'd avoid it?
So if I look at the relative rotation chart, IT is the only sector where strength and momentum both are visible in the market, especially about Indian market. Most of the sector either started to witness lagging in momentum or strength is missing. But IT is one where strength and momentum both are intact, and we have seen a decent recovery in last 7 days. So I believe if market has to hold, IT will be the leader. However, some of the stocks are finding pause or sustained cold writing at higher levels. But TCS is going to be the strongest name. Decline could be both. However, selling pressure is visible in the broader market. So because of that, some dip cannot be ruled out. But buy on decline will be clear stance in TCS. With support of 4100, we are expecting an up move towards 4280 level. In IT name, my preferred pick will be Coforge. The stock has been making higher top, higher bottom. Every small decline is being bought with support of 7850. We are expecting a run up towards 8500 in Coforge.
That will make the stock very expensive, by the way. But yeah, point well noted. Chandan, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time this morning. Much appreciated. Okay. Kush Bora, a lot of these liquor companies, despite good numbers, have come off. What are the charts suggest? More downside here? Allied Blenders, Piccadilly Agro, United Spirits. Any thoughts?
Well, you're right. I mean, we haven't seen that kind of traction that we were. That build-up hasn't really culminated into an uptrend or even consolidation for a lot of these names. And, barring maybe one or two, the United Spirits, if you see, it's broken the 200-day moving average, trading below that. Even United Spirits, which perhaps is in some way, a bit of a standout. But even there, you've seen some kind of a pressure, at best consolidation. So if I were to really pick one, I think it'll be United Spirits. The stop loss on this one comes around the support zone of 1400. On the upside, it could look at 1500 and 1540 as the targets. But that is from a medium-term perspective. The momentum's missing, and as you rightly pointed out, some of these have fizzled out. So I'll wait and watch, except for perhaps United Spirits.
Okay. Mayuresh, before we thank you, anything that stood out in the last couple of days in results? Quick 60 seconds, Mayuresh.
Azad Engineering was one number where I think the numbers have held up pretty well, and they've got a good prospect in terms of pipeline as far as the orders are concerned. The second number probably might be a few days back, so not necessarily the last 2 days. I think a few of these agrochemical companies, Neeraj, should be kept on focus and radar as well. Good monsoons, expectations of good Rabi output, and therefore these domestic players like Paradeep Phosphate, Sumitomo might actually hold up as far as I'm concerned.
Okay, Mayuresh, we'll leave it at that. Thank you so much for taking the time out and being with us today. Really appreciate your time this morning. But since we're talking of earnings, we have a minute left for the markets to kickstart trade. But get in Varun Lochab of HDFC for a quick perspective. And Varun, we just have a minute left, but a quick 30-second answer, and then we'll do a detailed conversation after market opens. But Varun, earnings season, disappointing. Are you revising EPS estimates downwards? Quick 30-second view first.
Yeah, so it has been a disappointing one. We were already below consensus. We were penciling in only 5.5% earning growth for this year, right from the beginning of this financial year. So for us, the downgrades have still been only to the tune of 1.5-2%, but nevertheless, there have been downgrades even on muted expectations which we had.
Okay, Varun, we'll come back and probe this a bit further, but the markets are about to start. So let's get that. And Kush, request you to stay on because would want a quick view from you post markets opening as well on specific pockets. But 13 seconds left for the markets to kickstart trade. You'll probably expect a sedate start. The question only is, can it fall further from those levels? Because the world is, unlike the last few days, not the happiest of places. Not that we've taken too many cues from the world markets, to be honest, in the last few days. But here are the rates. A red, 0.25%, banks 0.25% as well. Wonder if IT is doing the same thing. Nearly that. Actually, a lot better than the Nifty, to be honest. Mid caps and small caps could also be starting off sluggish. 0.5% for the mid cap index, the small cap index 0.64%. Portfolios yet again bleeding on open. Let's get the heat map up on the screen. More red than green. Most certainly that's the template. Only 2 stocks in the green, only 1 in the green. That's quite something. We haven't seen this bad a breath on open in a few days really. M&M, Maruti, iShares, seems like autos is taking it on the chin today. Maybe rate cuts being pushed back is the reason why autos are sulking today. Trent is down, BPCL is down, Ultratech, Bharat Electronics, Nestle. So a lot of stocks correcting, not too many winners. That's the news from the large cap, Samina. Not too much to mark, but for the fact that autos are sulking. Don't see banks though in the top 10 losers, which is probably a bit of a respite, Samina.
I do think it is settling down. It's respecting 23,800. So while that picture has opened up badly, there is a good chance that we may actually get better as we go along the day. Maybe a chance, maybe a hope, but we'll have to wait and see what happens in terms of trade. While the broader markets aren't doing too badly, there are a few good movers. Quick check on the mid and the small cap index before we take you through what's moving the market. Well, the Nifty 500 is down 0.5%. Stocks like KNR on back of earnings are having a field day. KNR is up 12% and continuing to go from strength to strength. Nykaa is looking good, post earnings up 4.5% on the stock in early trade. EIH is up 3%, KPIT is looking good, Bosch is looking good, Varun Beverages is up about 1.5%. That acquisition and a 37% upgrade, price upgrade from Citi is what's helping the counter as we see it. GSFC, those numbers were bad, but the stock gets a positive reaction, trades with a 4% gain, largely because maybe the expectations were running quite low for GSFC in this quarter. A quick check on Ashok Bilcon as well. Numbers were solid. BSE reported numbers that beat street expectations. Both those counters are up and about. Ashok is up 7%. BSE is trading flat. A quick mention on PNB Housing as well. From what I understand, 2.5 crores, which is 9.5% worth of equity, has changed hands at 943 rupees a piece. You want to look at that, 943, so it's actually much higher than what the stock currently trades at. 6% cut on the counter, but because it's coming at a slight premium to where the counter is at, you will see a little bit of movement on the upside on the stock. PNC Infratech numbers were bad. The stock is seeing a cut of 5%. Godfrey Phillip, M&M, Motilal Oswal, asset management companies, tire companies are all trading very clearly with a negative bias. But it's about the earnings. The street is hugely disappointed. And Varun, you want to continue telling us about what stood out for you, what didn't. Consumption seems to be the huge disappointment for everyone on the street. And the worry is, especially from what Britannia as well commented on, urban consumption is a bigger problem than rural was at the start of this year. Where is your biases? What do you feel is the outlook? Do you feel like the second half of the year could bring it with it some good news?
So I think, yeah, you're right. Urban consumption has been a bigger pain point this quarter. Last entire year, it was more about rural consumption being weak. Now, I think some of the issues on urban consumption are looking structural and will not go away in a quarter or two in our view. Because one, if you look at inflation, that has been a cause of concern, urban inflation eating into the spending power for especially the lower strata in urban. And secondly, the structural issue of fragmentation with more and more brands being available now easily on, through D2C direct or through the quick commerce platforms. So therefore, the incumbent FMCG players will have to face the issue of market share loss over a sustained period of time. So I think consumption, as you rightly said, has been weak. We don't expect any significant improvement in the second half either, at least on the urban consumption side. But at the same time, we believe rural consumption will continue to probably improve in the second half as well compared to first half, and therefore that will provide some support. But overall, we don't expect any meaningful recovery in urban consumption.
So that, of course, will impact the volumes, and most of these consumption players have posted early single-digit revenue growth. The other problem that was very obvious is the kind of margins that they've been posting. There has been an inflation worry. There is the fact that raw material prices are on the upswing. Are we saying then that while revenues may remain subdued because urban may not see a big pickup, even margins will remain weak? Because if that's the case, then your bottom and your top line are both under significant pressure, which means some of these counters will continue to correct, to adjust to the new normal.
The disappointment has been more due to lack of operating leverage and lack of top line. Frankly, gross margins are still fairly healthy because raw materials have not seen much inflation for most of these companies. The issue has been that to spur growth, they have either kind of increased their ad spends, or generally, because of inflation running at 6-7%, which is higher than their top line, there is negative operating leverage on most of the other cost items. So So unless top line improves, we don't see margins, improving for the sector, even with gross margins remaining fairly benign. If you look at, there has been further correction in most of the commodities, or they are stable in the last 3 months. So we don't expect a significant gross margin pressure in second half, but margins will remain muted because of lack of top line. So unless top line starts growing at 8 to 10%, there is bound to be some margin correction at EBITDA level for most of these companies.
Varun, yes, and we were showing this chart of Britannia and what Britannia had to say. I understand we have 2 more minutes with you, Varun, or 3 more minutes, so we'll let you go. But just one question. If Britannia is saying that metros are leading the slowdown, does it mean that it will translate to all other forms of urban consumption as well? And could this be temporary, Varun? Because frankly, there's been no loss of income per se at the urban end, right? I mean, rural jobs were getting impacted. Urban, I don't think was impacted too much. So where is this concern coming from? Is it long lasting, or is it cyclical and will get corrected in a quarter or two?
See, part of it is FMCG related also. If you look at, if you look at some of the other segment like consumer durables has been doing reasonably well. Our channel checks are suggesting even, the festive season demand was good. Similarly, even autos for that matter, the festive demand was good. Real estate still there is, a decent festive demand. So it is partly due to FMCG because of the, fragmentation and loss of market share issues, which I talked about. So it's very category specific. I don't think there is a very big concern on overall urban consumption. Some of the discretionary items, some of the other pockets like, telecom tariffs are increasing. So there is a share of wallet going towards that item. So I think FMCG, there is more a case of loss of share of wallet, but some of the other consumer segments, even apparel, eating out, we believe second half could be better than what we have seen in the first half. So it's a mixed picture. I would not say that there is a big red flag on overall urban consumption.
Okay, Varun, one quick question is on autos. I heard you say that auto demand looked okay, but it doesn't seem like there is. It seems like there was a structural shift away from at least the four-wheeler demand being very strong. Festive may be an aberration, or do you reckon that it's the start of an upswing in passenger vehicles?
No, there is no big upswing in passenger vehicles. Like, two-wheelers has seen a better demand compared to four-wheelers. Four-wheelers, actually, passenger vehicles, if you look at last 5 years, 10 years, growth rates have been muted. And we believe it will continue to be in that mid-single digit kind of range.
Well, I guess we still have 1 more minute with you, Varun. And I'm going to quickly try and get a question on banks. In terms of banking earnings, very sort of diverging trends were visible. You want to shed some light on how did the PSU basket do, in your opinion, and how did private sector banks do? Because it seems like the likes of an HDFC, which I know you can't comment on, are making quite the comeback.
See, I think generally large banks with a very well diversified sort of a loan book have done better, be it private or public. And by the very nature of it, public sector banks have slightly more well diversified book. If you look at the pockets of stress were only in microfinance, credit cards, and some of the unsecured personal lending. So banks which are not exposed much to that, be it some of the large banks like ICICI, Axis, HDFC, or the public sector banks like SBI, Bob, most of them have done well. The issue has been more with specific NBFCs or banks where business model is more tilted towards unsecured or credit cards or microfinance, and so therefore it's a very mixed bag and a very divergent sort of a thing in banks, and therefore individual bottom up stock picking. We believe that has been our call for entire last year. We have been saying for last 6 months that valuations are stretched, easy money period is over, you will have far more muted returns going forward, and therefore bottom up stock picking will play a much bigger role than sectoral views or overall market views, and we believe markets are going to remain tough from a aggregate level, and therefore you have to probably do more homework and you have to be very convinced on what you are buying.
Okay, Varun, we'll leave it at that, but thanks. This was good talking to you, Varun. We should try and connect more, but thank you so much for taking the time out and speaking with us today.
Thank you.
A short conversation with Varun Locha, but clearly gave us some good insights on consumption, Sabina, and a little bit on some of those financials. But I wonder, Kush, how have you observed the market open today? Because seems like almost everything, but for the small caps, is opening flat.
Well, it's a bit of a mixed kind of a view, and I'll tell you why. Nifty, from whatever low it had made, has seen some sort of a rebound. Bank Nifty is already in the green, so you'll take heart from that fact. But a lot of stocks that had opened in the green have actually given way, are seeing profit booking. So Nifty rather is very delicately placed. I still maintain a positive view on the Bank Nifty. If you were to go long, then that is your index. You have to place a stop loss about 50,800 and thereabouts, and then play for higher levels, 51,500 and 51,800. Nifty, I still repeat, while there are green shoots, it's still very delicately placed. So you might just want to wait and watch, on the Nifty. Bank Nifty is your long trader.
Bank Nifty is swinging between gains and losses, now positive, marginally high, and the Nifty itself also looking a lot better than it did. A couple of other stocks, Kush, that I want to quickly highlight on. What are you doing with BEL? This was showing some strength over the last few days. Is this looking good to you? And I want to quickly get a check from you. I mean, I know Chandan put out Ramco Cement, but the stock is actually under pressure as we see it. Do you have a contra call on Ramco and BEL, if you can share your views?
So on Ramco, I would avoid a trade because what we saw was a very wild kind of a move yesterday, and it's not sustaining today. It's sort of a given way. While the trajectory, if you look at the averages, the trajectory and the slope of the averages is on the way up. With the kind of move that we saw yesterday and the cooling off that we're seeing today, I would perhaps hold up on that trade. It popped up on our lists as well, but we held up given the kind of move that we saw yesterday. BEL, I've maintained that this is a good buy, but from a medium-term perspective, if you've got a 6 to 12-month kind of a horizon, that's when you consider BEL. It's not cracked, as deep as some of its peers, holding its 200, 20-day moving average, 50-day moving average convergence. So if you're looking at adding, a defense stock on the rebound as a contra play from a medium-term perspective with all those caveats, BEL does look like, a decent buy.
BEL looks like a decent buy. That's the view coming in on the counter. That's a consensus buy call from two of the guests on India Market Open. Ramco, Kush not too convinced because the stock has already had a very solid run yesterday. Today could be a day of some cooling off. But it's Borosil Renewables that we should be talking about. If I can pull up the stock and then go over to the management, the stock is under pressure. Numbers were also fairly muted this quarter. Pradeep Kumar Kheruka, Chairman of Borosil Renewables, now joins in. Hi Pradeep, good morning. Thank you for joining us. Pradeep, just quickly do a quick check on how the quarter has been. Revenues were down over 7%. Material cost has seen a big jump of nearly 15%, which has very clearly impacted your margins as well in the quarter. How are you mitigating these cost pressures? Are you expecting material costs to remain elevated going into the next few quarters as well? Give us a sense of what you're thinking and what the new normal would be.
So actually, we have had an improvement in the standalone results, quite a definite improvement. When we look at the consolidated results, that takes into account our German operations as well, which is completely different from what we are doing here. So I would, focusing on the standalone, EBITDA has gone up significantly. And that has happened because of higher prices of imports on account of ocean freight. So the ocean freight went up and therefore the prices went up. So the Chinese producers did not reduce their prices. So the dumping continues, and we feel our application for an anti-dumping duty has been recommended by the Ministry of Commerce. It's gone to the Ministry of Finance, who will vet it, and then they will take further action on that. So we do expect that the anti-dumping duty will be imposed. If that happens, that will have a significant improvement to our results. Other than that, our production has been improving and efficiencies have been going up. We have been able to implement certain savings on account of a larger share of our energy is being met from renewables, which is being generated by us in an associate company. So from that point of view, with the receipt of anti-dumping, things would change dramatically.
Are you expecting a decision from the Finance Ministry? And Any clarity? Have you spoken to them? Should it be this quarter? Should it be the quarter after that? Because this is impacting business, and it's also going to, I believe, have an impact on your pricing strategy, because there have been aggressive price cuts that have come in from China and Vietnam, right?
That's right. So the price cuts that have come in can only be met by this anti-dumping. The way the ministry has recommended anti-dumping, what they have done is they have issued a reference price. So the reference price means that goods coming in have to be at a minimum import price, and whatever is the price in the invoice and the difference would become the duty. So it is not an imposition on the domestic manufacturers of modules, because now they know that they will get their glass at least at that price, and in that sense, it would be a good thing. Now, the way the law is that the imposition was, the recommendation was given on the 5th of November. There are 90 days within which the Ministry of Finance has to take a call. So within 90 days, we would be in a position, say by the 5th of February at the latest, we should be able to see a result from the ministry. Meanwhile, the way the things have been going right now, there has been a lot of support by the government for renewables. So we can reasonably expect that this should be received. If this comes in, it would be a game changer for us.
Mr. Kheruka, so if it's the timelines that you mentioned, and excuse me for not quite getting all the timelines on the button, but does it mean therefore that for now Q3 as well could have some of the stress that we've seen until the things get reviewed and changed?
That's right. There would be some stress possible in Q3.
Okay.
Because our efforts to improve production continue, and we have been quite successful in that. We are already making nearly 100% capacity. So we are running at about 97%. So we might improve on that as well. So we should see something good. And in case the government decides to do it earlier, then that will be very good. So of course, we cannot bank on that.
Mr. Kheruka, the other question really would be that one is of course on the cost pressures that come in, but two is also on what happens to volume growth per se, because I mean the belief is that this is a sunrise sector, and it's a decadal story, and small hiccups notwithstanding, volume growth numbers should look year after year very, very promising if companies have the right capacities in place, gauging by the demand supply scenario. What's your sense, sir, on that? How does, let's say, FY25 shape up despite this couple of quarters of hiccup that you are seeing? And what happens FY26, FY27 onwards based on demand as well as the capacities that you may have on stream?
So to give you an idea about the demand, the domestic production is perhaps around 2,300 tons per day. And the imports in the month of September were 9,700 tons per day. There is simply no dearth of demand. We can make as much as we like, and it's going to sell. In fact, the capacity which is waiting in the wings to be implemented is at least twice as much more than what is being produced in the country today. So there is going to be an enormous, in the event that this happens, then Indian industry will triple in size. And in fact, it's set to triple in size.
So, okay. So in which case, again, I'm just trying to understand this correctly. You say, or you reckon that the volume growth numbers will start looking good only when the quantum of imports gets rightfully corrected. So even if the demand is there, it is getting flooded by the imports which are cheap or dumping or what have you. And until they get sorted out, the numbers may not necessarily look good. If it gets sorted out, then you revert to some fairly strong demand numbers.
Absolutely. I mean, this is the demand is very strong. The product that we make is very good. we get higher wattage from the panels which use Borosil glass as compared to other glass from China. So all of that is there, but it's just that the price is the bone which is sticking in the throat. And I must say that the Chinese have reduced prices by 32% in the last 6 months. And there has been absolutely no reduction in the cost of any input whatsoever, which is used in the manufacture of glass. So this is completely a political dumping which is happening, which is designed to make Indian industry very, very loss-making. And therefore, they want to stop Indian industry from flourishing.
A fair point, sir. So just one quick question. Of course, demand, like you said, is robust, right? And in that context, what is happening on the manufacturing front? Any PLI schemes or incentives that could boost domestic solar manufacturing? Are you leveraging any of that? You want to tell us about any expansion plans that you've got lined up to keep up with the increase in demand and hopefully a stop or the anti-dumping duty being put in place?
Well, it's like this. The PLI scheme has not been extended to glass or any other component. So far, it is only on the manufacture of modules and cells. Now, coming to the question of investments, as I said, investments have been lined up already. We have investors who are ready to invest. They're waiting in the wings. The only thing they're looking for is a price which matches the cost of production. And at the moment, the selling price is way below the cost of production, which is the issue. And for example, let's look at Borosil, our own company. We have already got a batch house, which is good for 2,000 tons per day. We are making 1,000 tons a day. So that money already stands invested. Our power connection is more than twice what we require for the 1,000 tons that we manufacture. So that money has been spent already. So we have already spent for the growth. And when we do come around to being able to action our growth plans, we will definitely be able to, we would have a head start and our capital cost would be a little lower than somebody else.
One last question, Mr. Kheruka. Would you, in this ensuing period, need any kind of capital raise to fund the ongoing expansions that you may have, considering that because of the temporary issues, cash flows, etc., might be getting hampered?
You see, the entire business of acquiring finance or of raising capital, it's a strategic call, and we have been working towards it. As you are aware that we had obtained permission for raising capital by means of rights issue. So that has been there already. It's very much on the cards. We are waiting for some further clarification or some little approval from somewhere. And then we are in position to launch our rights issue. And the purpose would be to raise capital, which could be used either to repay existing debt or it could be used for further growth.
Right. Sir, this is great perspective because it helps us understand what lies ahead for Borosil Renewables. Hopefully, you will swing back into profitability as soon as that anti-dumping duty gets reinstated as well. But good luck. Thank you very much. Great talking to you this morning.
Thank you so much.
Thank you, sir. Well, keeping up with earnings conversations, Samvardhan Motherson is also in focus. They've reported a strong set of numbers. Pankaj Mittal, CEO of Samil, and Kunal Malani, CFO of Samvardhan Motherson, will be joining us, or rather has spoken to us yesterday. Let's quickly go across and hear out what the management had to say as they, of course, outline what lies ahead and what went behind the strong quarter that they reported.
I think it's a quarter which was expected to be weak. As you know, it's a seasonally weak quarter given the European shutdown. So there was a certain expectation of on a quarter-on-quarter to still be able to support it. Having said so, we did get a little surprise to some extent about the decline in the market, the sharp decline in this quarter. The overall industry volumes fell by around about 5% on the light vehicles and 6% on commercial vehicles, with around about 15% dip in the European market on the CV side as well. So Europe particularly was hit hard, and that came as a bit of a surprise to us. At the same time, the entire globe, whether it was North America, China, India was the only one which had a neutral growth. Everyone else was down. So pretty much across the globe, things fell. Now, when we look at our performance, we outgrew the market by 4 to 5%. The market grew by, as I said, by around 5% on light vehicles. We, however, on organic basis, grew by 1%, and hence we outgrew the market there. On top of it, our organic business performed well, and hence the overall revenue came in at 18%.
So, Mr. Mittal, just
and when you look at the bottom line. Sorry, go ahead.
Yeah, I just wanted to bring in Mr. Mittal into the conversation at this point of time. You're saying that you're growing about 4 to 5%. So what is different that Samvardhana Motherson is doing at this point of time that is allowing you to deliver such growth? Mr. Mittal.
So basically, as Motherson is known for being a sustainable solution provider to its customer. So one of the key aspects is to find solutions, and that also includes inorganic growth. So we are acquisitive in nature in that sense to find solutions for our customers. So rest of the growth has also come from acquisitions. So on an overall basis, you would see that we have grown by about 18% with respect to the same quarter last year.
Yeah, Mr. Malani also mentioned about the fact that there is pain globally and there is neutral growth in India. We are just days after the US elections. The scenario among your top 5 clients, actually, all of them have actually tempered their growth expectations for the coming 6 months or so. So how is the scenario looking in the second half of the fiscal at this point of time?
Look, that's why we say it's a volatile environment and uncertain one.
So you think the situation will get worse even here on?
Difficult to really guesstimate. For the simple reason we have a completely new government coming into the US. You don't know how that is going to play out, what happens to geopolitics, which to some extent has been pulling down the volumes as well as creating issues from a working capital supply chain perspective. So don't know how all of this is going to get played out. So the way we have positioned ourselves is to be reactive.
Okay. Coming to you, Mr.
If you look at our diversity has gone up.
Okay. I think this is a voice problem there, but I'll just take the next question to Mr. Mittal now. What explains the jump in the net profit that we have seen in this particular quarter? Can you just talk to us through that?
See, all our teams across the world have done well in these difficult times. So on an organic side also, we have continued to improve, control our costs, and also the inorganic growth which had come through the acquisitions, they have performed well. And that reflects in our profitability. And while you asked the question about the future, we believe as we are an acquisitive company also, and we continue to find solutions, we have also deleveraged ourselves so that we have a very good headroom. We have reduced our debt profile to 1 time of EBITDA, while this quarter is seasonally weak because of holidays in Europe and other places, and the working capital is at its peak. So we do believe that in the next 2 quarters, our leverage should come down even further. And that will keep us in a very strong position that wherever our customers want, we would be able to find solutions and remove the pain which comes into the market.
But at the same time, you've also reduced your Capex guidance to about 5,000 crore rupees. Is it in line with what you're expecting in the next 6 months?
What we have done is it was 5,000 plus minus 10%. We have said it will be plus minus 5 because we do see that there have been many programs which were delayed by the customers. So while we do not reduce the plants which are coming in, but we can tweak with the investments which are coming, and we can fine tune better so that we are timing it according to the launch of the model by the customers. So that's why we have kind of tempered it and reflected more clearly.
Mr. Malani, Mr. Mittal just touched upon the deleveraging bit what we have seen. So just wanted to understand what is the glide path here on. Are you going to look at a net debt zero in some time to come? What is the end goal as far as leveraging is concerned?
No, we don't have such goals of getting to net zero. Our objective, PIP and the system was to strengthen the balance sheet so that we can go and work with our customers to find solutions in the supply chain. So in an environment like this, you can imagine the weaker players will have a lot of challenges, and hence a stronger player like us can potentially provide that solution. The way we directionally see going forward on the leverage piece, we were at 1.5x in June, we are at 1x now, and by March we expect it to lie somewhere between 0.5 to 0.75x. That's what we can see till March, and thereon it's a function of how things play out.
Okay.
The organic business will deliver irrespective. It's the inorganic which we don't know when it will happen and in what form fashion it will happen, and then the leverage will go up. But we'll always be within our financial policy and management comfort level.
All right. Coming back to you, Mr. Mittal, again, how is the expansion plan going ahead? You said in your investor presentation about 5 out of 19 greenfield projects have come on stream. Given this macroeconomic scenario, the geopolitical scenario, is there likely to be any change in your organic expansion plans, given also how you have actually tempered, so to speak, your Capex plans?
I would say that we have fine-tuned the Capex plan to bring it more close to the reality as we move closer to the time, and also the expansion plans, all the sites which we had announced, we continue with that path because these are backed by the customer orders. So we didn't decide to set up these facilities just like that. They were all backed by the orders, so we have to execute those orders, and we set these facilities up. We also are growing very well on the non-auto business, and these plants also include the non-automotive business, which includes the business of consumer electronics. And the first batch of customer deliveries have been done, so the plant is on stream. The bigger plant will come up over a period of time, and the ramping up of serial production will happen in the next quarters as we progress.
All right, that's of course Samil and their conversation, and a clutch of notes have come in today. Just pull up that stock once, which have said that, I mean, there are concerns, and thankfully the management was candid enough to say that with the new government, etc., we don't know what the policies will be, and therefore the impact on global sourcing, etc., all remains unknown for the time being. I'll tell you what else is looking slightly skittish today. I wonder if actually just pull up the stock price of Sula Vineyards, because when it started off, I think it started off skittish, down about 6%, because it was, by the standards that they've set as well, a disappointing quarter two. Revenues were flat, margins were lower at 25.4 versus 33, net profit down 37%, better than estimates but lower for sure. Rajiv Samant, CEO of Sula Vineyards, joins in to talk about what happened in the quarter and what the outlook ahead could be like. Rajiv, thanks so much for joining in. Good morning to you. What happened in the quarter, Rajiv? I mean, the revenue numbers were stable, but below the revenue, the operating numbers took a fair degree of beating. So what's gone in the quarter?
Yeah, it was a fairly tough quarter. In fact, the last couple of quarters, we have noticed definitely a slowdown in a couple of our key markets. Sula's sales are very much skewed towards urban areas. I would say something like 90% of our sales happen in urban areas, and we have been seeing some amount of consumer stress there. And then our most important market of Maharashtra also has seen slight degrowth, and that is our most profitable market as well. So in this quarter, what we have seen really is the emergence of Telangana, specifically Hyderabad, as a very important market for us, which is great because, we've always been seen as a primarily two-state company, that is Maharashtra and Karnataka. Now we have this third state, Telangana, which is fast catching up to Karnataka. Zoom in sales there. Unfortunately, Telangana, due to fairly high taxes, is not as profitable as the rest of the markets. Hence, you see a stable sales growth, but a decline in profit. So Maharashtra has been hit. Mumbai and Pune have both really been weak these past few months for several reasons. We hope to see that turnaround in the not so distant future, and the growth of Telangana that is showing on our EBITDA.
That's good to know. I mean, it's always good to have more markets, because at some point of time, hopefully Mumbai, Maharashtra recover too. But just before I get to the top line numbers, Rajiv, the taxes, I reckon, will have an impact below the operating line, or does it impact your EBITDA margins as well? Because the EBITDA margins also have cracked about 800 basis points.
It directly impacts our EBITDA margin, because these taxes they show up in our in the net revenue figure. So what happens is our ex-winery price is significantly lower in some of these states due to high prices, so high taxes. So it directly impacts at the net revenue line, but it has a far bigger impact basically on EBITDA.
Okay, fair call. Now, I heard you mention that there seems to be an urban slowdown. Now, it could be well in the key states that you are at, or countrywide. Just wanted to understand, because you would be looking at this in terms of cycles, right? Does this change?
Very much so.
Did the festive season bring about a change in the O&D quarter, or for now things are not quite turning?
So we have reason to be optimistic. I do feel that the bounce back, we're going to see it probably more in Q4. We still have a few soft concerns in O&D, chiefly due to Maharashtra elections, our most important state now going into state elections. A lot of restrictions happening as we speak in November, a lot of excise restrictions. So there is going to be a dampening effect in November. Though I'm pleased to say that in terms of wine tourism, things are definitely looking up for the second half of Q3. A lot of advanced bookings, and it looks like there's a lot of good festive days. So good things to be cautiously optimistic about. CSD, I would like to point that out. That's been a great performer for us, and we have good news. We've just gotten 4 new brands, including our top-selling Dindori Shiraz, approved by CSD. So that's some good news for the future. And we look forward to Andhra Pradesh opening up. We've been out for the last 5 years. We withdrew voluntarily, and we're going to be going back into that state pretty shortly. So some good reasons for optimism. In terms of the urban slowdown, Mumbai, Pune have been hit. Pune had some adverse factors due to, there was an incident that happened there which really affected sales in Pune for around 2 months. There was where a car had, injured a few people, etc. And the entire institutions across the city were shut down for basically a couple of months. Hopefully we are bouncing back from that now. So reasons to be cautiously optimistic.
Rajiv, the other question is, when does growth in some sense come about? I mean, wine is a growing market in India, not quite a mature market. Wine tourism and some of that is also a very nascent stage. But when I look at a slightly elongated period, right, from December 2021, when I look at revenue numbers, they've largely been between that 125 to 175 crore mark. Correct me if I'm wrong, but I think that's where the number has been meandering. So it's not a 12-month period. It's like a 3-year period that I'm looking at. When does this start translating into bigger numbers? Is there, or is there something else that is constantly happening which is hampering this?
We are very optimistic that it will translate into bigger numbers. The macro factors for wine speak for themselves. I do want to point out that from 21 to 23, we showed very robust growth. Perhaps there was some element of restocking and overstocking coming out of COVID, and we've been seeing some amount of destocking, especially in wine, over the last 6 months. That's what we have really noticed, and that comparative will start to get much better from Q4 onwards and FY26 onwards. So we believe very strongly in the long-term wine story. These are still very early days for wine. We are trying to convert people, a person, 10 people, 100 people at a time away from spirits and towards wine, but it's happening. Sula is by far the strongest brand in wine in India. So we are very confident for the future. But it is a cyclical business, and we are seeing a slightly difficult part of the cycle right now.
Okay, so March 21 from nearly 385 crores to 516 crores, trading 12 months 579. Hopefully these numbers show an improvement as well. At 30 seconds, Rajiv, if you can, would operating numbers also show an improvement from the JFM quarter? I understand the current quarter is bad.
See, I've always been saying, we zoomed to 32, 33% EBITDA. And I was always saying on all our earnings calls, all our guidance, that it had reached a bit of an unsustainably high number and it was going to moderate. So you're starting to see that moderation. I do hope that we can show better EBITDA moving forward, but I don't see us going back to that 30% plus EBITDA situation. All our stars were lined up at that time. And I do feel that something more between 25 and 30% is more sustainable, and that's what we're going to see in the future.
That's candid enough. I remember this comment as well. But okay, Rajiv, unfortunately, we are out of time today, but would love to talk maybe closer to the end of December to try and understand how has the quarter been and what the new year brings in store. All the best. Thanks so much for taking the time out.
Absolutely. Thank you.
That's Sula Vineyards. A bit of a tough quarter. The management candid enough to say that the next quarter also might remain tough. Maybe Jan, Feb, March improves. Mid caps, small caps under a lot of stress. We have to wrap it up on this leg of India Market Open. Up next is Talking Point. We mark Swiggy and we talk about healthcare. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Traffic 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, would I...
Okay, that's Swiggy and expecting about a 5% uptick. 5% uptick on Swiggy's listing. Let's cut that audio, please. We don't need the audio of the lady, but we'll probably have a start which is about 5% higher. The question only is, can it build on from there or will it see some selling? Now, remember, the lot of talk is that Swiggy's valuations, and Samina is with me, that Swiggy's valuations are a lot more reasonable than Zomato, but Swiggy a few quarters away from profitability relative to Zomato.
Yeah, I think, so this lady's voice is okay, right? But yeah, 5%
I was not being sexist.
No, I'm joking. A 5% premium is actually better than what the expectation has been over the last couple of days. What also worth noting is that before they went to IPO, their unlisted trade or the last trade that took place before they filed for the DRHP is close to 420. So a good possibility that you may get a flat start and build on that as we go along through the day. But very significant marquee names have come in from what we understand. You had a couple of insurance companies. Norgis was one of the big guys that put money on Swiggy as well. So yeah, 390, 395 is what the expectation would be. It'd be interesting to see what Zomato is also getting up to as we see it. Flat start, as expected. 1% is what the market was expecting, and that's exactly where we are seeing Swiggy at 1.5% higher, bang in line with the grey market premium. So flat start, but I don't think it's complaint worthy. The broader sentiment of the market is weak. If you can pull up Zomato as well, let's just take a check of how that one is doing, because it's the only other listed player, and this industry member is a duopoly. So you want to keep in mind that Swiggy and Zomato will be fighting it tooth and nail for the rest of time till there's a new entrant in the business. That stock is down 1.5%. At 395, Neeraj, in line, especially given that the excitement and euphoria was not so visible until the last day that the subscription closed out. But 390 is what we have on the screen. I think most investors would be rather pleased, because I think it will improve as we go along through the day, as long as the broader sentiment supports the street.
Yeah, so that could be one thing as well. The other thing is, I mean, relative between Swiggy and Zomato, now that it's a sector that has gotten formed, what happens next? Rahul Jain, Director Research at Daulat Capital, who looks at this very closely, joins in to talk about this and more. Rahul, really good having you, and thank you for taking the time out. Important day to have you. First, the obvious question, what do you make of the listing?
Yeah, I think what we saw of the valuation, and if we do a little bit of comparison of where it stacks up was in terms of fundamental versus valuation to Zomato, I think the valuation was pretty fairly priced, and that's why we could see that there's no much big swing at the listing. So that's what we were thinking, that what Swiggy is at this point and where Zomato is at this point, it may probably, one can think it's closer to 18 to 24 months behind Zomato's fundamental. And this is a similar valuation what Zomato was commanding that time. So I think that way it's very even Steven from a valuation point of view.
Rahul, sure, the valuations were compelling. Numbers as well, from what we understand, Swiggy is a few quarters out from where Zomato is, and that explains why this came in at a deep discount to Zomato. But is that the only reason or the only sort of justification for one to be constructive on Swiggy? Because discount apart, you also want to look at the business, you want to look at the cash flow, you want to look at where that money is going to be spent, right? Where do you feel that bias sits? And also in terms of market share, Zomato is leading with a little bit of market share on Swiggy.
Yeah, I think to your market share point, we have seen Zomato has gained significant market share in on the food side of the business in the last 3.5 years. Some bit of it has also been contributed from the brand appeal, which has improved significantly for Zomato post listing, and also because of its overall engagement. I think from a comparative perspective and cash flow and financial perspective, which you are saying, I think one way the valuation has an upside because of the fact that it's a very, very large time on the e-commerce or the quick commerce side, which is kind of a proven now. While the challenge now going forward would be the increased competition that we would see on the QC side. In fact, Swiggy, with now its much awaited IPO being done, may probably get more aggressive on the food side also to claw back some of the market share that it has lost. So I think we would see more competition going forward, better for consumer out here. And as a result, we see both the companies may not see a meaningful upside from where it is today. The other increased competition would slow down the EBITDA progress and probably would mean much lesser return going forward.
Well, if you were to put your money in today, where would you do it? Would you buy Swiggy or would you buy Zomato? What have you told your clients to do?
Or none of them.
Or neither. Yes, I guess Neeraj wants to jump in with neither.
Yeah, I think thanks for adding the third option.
Oh, no.
Basically, in that camp. Of course, if you are a very, very, very long investor and you more care about time and opportunity and see how the decision making shift from the current consumer set to completely Gen Z ecosystem at some point of time. Of course, these companies would do really, really well. Our view of not suggesting anybody to add at this point is, as I said earlier, the competitive landscape in this business, both on the food side slightly and much more on the QC side, would play out over next 18 to 24 months. And that would mean there would be limited upside on the EBITDA. In fact, Street would see probably contraction to the current estimate. So that is what is making us slightly worried about this space. For a real long-term investor, of course, these are large time and good play to them.
Okay, so that's the verdict. Neither of the camps right now. Maybe so. Just before we wrap up, Rahul. I'm sorry if you already mentioned it, but just trying to understand. Assuming that other things remain the same, and assuming that the broader multiples for the markets remain the same as well, what levels or what valuations would you find comfort in buying them? Would it be 15-20% lower, assuming ceteris paribus other things remain the same? Would it be 25% lower, or would it be more?
If you look at the current operating profit of the business for Zomato, is still a small number compared to its valuation. It would sound 100 of X, right? So, and Swiggy is yet to get into that positive annualized cash flow on the operating side. So, of course, the valuation 15% down, 20% down is not something which will become very mouth-watering. What we need to better gauge on that how, just like how the food business eventually became like a duopoly, and there is a gradual pricing power that is getting played into it, as we see from platform fee getting increased every now and then, compensating for the increased delivery cost. I think we need to see that how in QC business also it would get stabilized. So since there is such an aggressive plan wherein companies are talking of doubling and tripling of the capacity, these are not easy asks where you double, triple capacity and also want it to be efficiently run. So I think valuation would be more function of how the competitive landscape shape up, and pure correction by 10, 15, 20% would not make it an easy buy either.
Okay, well, difficult to call, but certainly not now. That's the verdict. Rahul, maybe in 3 months' time, we talk about this issue again. By then, maybe both of these might have traveled a fair bit. Whether up or down remains to be seen. But thanks for joining me today. Really appreciate your time. That's the view from Daulat Capital on Swiggy or Swiggy plus Zomato, and a tepid listing, not different anticipated per se, and expectedly so. The question is, Rahul is saying that you might not want to put in money even now, maybe wait for some more time or correction or both. What we do is try and talk about some of the things which might have some more reaction. Samina, thanks for joining in on this, of course, but it was important to get this view. One quick question, Samina. What is it that you reckon people would be watching out for the most when it comes to Swiggy going ahead?
I think margins. I think that's an important improvement, and the money that they have, that they're sitting on, where does that get spent? Remember, their food business is the key contributor for growth in terms of Swiggy, but going ahead, if they're going to put money on their platform business, that is what's going to be critical to draw the line or justify further growth in momentum. I think the other one also remains to be seen whether the stock hits that 410, 420 mark today. It's already going up, as we can see, and as we had indicated, we started at 395, at 400 odd is what we have the stock at. 420 becomes important because, from what I understand, the last price that the unlisted stock was traded at was about 420, 425. So you want to watch out for that too. There's going to be a lot more coming in. Remember, Zomato's also raised a significant amount of money in the last couple of weeks. Where that money gets spent for Zomato, where it gets spent for Swiggy, is something that will determine what happens to this new entrant on the exchanges. Also, increase in market share, that's going to be critical. Swiggy is sitting at 43% of the market share. Zomato, on the other hand, has about 47 in terms of market share.
Okay, so margins it is. Do watch out for that as the key.
57 actually.
Key determinant of what could happen to Swiggy, Zomato, and whatever else. So keep that in mind. Okay, now one talking point, an important conversation, because one bucket that is kind of stood out in different forms has been healthcare. I mean, individual pockets have really shown. There have been multiple companies getting the VAIs as well, and there have been some moves on that too. Aditya Khemka looks at this space very closely. Fund manager at InCred Asset Management, of course, needs no introduction, joins me. Aditya, just before I get to some specifics, because I wanted to talk to you about specifics today with you, because we've spoken a bit about the macro, of course, but just a word on the earnings season. How have you seen that for healthcare at large?
So, good morning and thanks for having me, Neeraj. On the healthcare side, I would say branded generics, API, hospitals, diagnostics, they have all met or exceeded our expectations. On the unbranded side, there have been a hit and miss. So there have been few companies which have met our expectations, few companies that have missed. So it's been a mixed bag for the unbranded bucket, whereas for the branded hospital, API and diagnostic bucket, it has been largely met plus exceeded expectation kind of an earnings season.
Some specifics that I wanted to talk, Aditya, with you, because we're seeing some of the things stand out. Now, you were amongst the first one to tell me that the rev limit benefits for some of the US focused companies will last for a while until they stop lasting, and the markets will discount that maybe 6 months earlier because the market is smart in its wisdom. Now, is rev limit aided sale no longer a driving force for Reddy's, Sun and some of the others, and is the market now already looking forward for the life beyond rev limit sales?
So I'm pretty perplexed myself that the market has probably not still discounted the fact that earnings will fall a cliff from once the rev limit revenues go away. I think the problem here, Neeraj, is that these pharma companies which are selling rev limit in the US market do not break out the quantum of sales or margins they make in a product like rev limit. And therefore, each investor is left to himself to estimate what kind of earnings are coming from rev limit, and hence what are kind of earnings are at risk once rev limit goes away in January of 2026. So my understanding still is that majority of these unbranded generic companies which are selling rev limit in the US will see a flat to decline earnings here in FY27 when you compare the FY27 EPS to FY26, because FY26 will have probably 10-11 months of rev limit and FY27 will not have any rev limit sales. And I don't think the multiples which they are currently trading at indicate that that possibility is discounted yet.
Okay, so, but are other things coming to the fore to help? Because there's a lot of talk about what, the new administration will do to pharma. I think that is arguably a very big talking point currently, Aditya. And I don't think too many people have clarity about what it would mean. So I'm asking you to hypothesize, Aditya. I'm not asking you a question about from my end, but I'm asking you, lay out what you think is your hypothesis. And if that turns out to be true, then what is the impact, therefore, on some of the Indian suppliers?
So look, from the new administration standpoint, we already had the Biosecure Act being passed in the US just before the new president took term. So clearly there is an anti-China, anti-Sino sentiment that is going to play out for the American or the Western part of the world. And from that, obviously, all the CDMO or CRDMO players in India will benefit. So I think that is something that is just as clear as day, and it will happen over a decade. It will not happen in a year or two, but it will happen over a decade. You will see material business moving from China to India over a decade. On the generic side, I don't think things will materially change because of the new administration, because anyways, Indian pharma companies supply products at competitive prices to the US market, which is desirable for the US healthcare ecosystem, and that should remain. So if you ask me what will incrementally change because of the new administration coming into power, I don't feel it will be anything different than what we have been saying for the past 2 months, 3 months.
Okay, Aditya, the social media chatter was also right that RFK Jr. is going to say that, oh, we want to dismantle the policies of big pharma in the US because American healthcare has been really impacted badly and they want to completely revamp this whole thing. So do you foresee that to happen? And if that happens, are Indian companies getting impacted in any fashion, positive or negative?
So, if you look at it, Neeraj, if I were the in the American cabinet and looking at the American healthcare cost, 90% of the American healthcare cost of pharmaceuticals is from patented drugs, which formulate only 10% of their volumes. And then generic drugs are 90% of their volumes and only 10% of their cost. So I would probably be far more critical of how the patented drugs are being priced in the American market, and would probably look deeper into that and try to sort of get that cost down, right? And a part of which we saw late last month, where the Medicare Part D negotiations with the innovator drugs was allowed. And that would bring down the prices of some innovator drugs substantially, at least for a portion of the market, a small portion of the market, but a portion of the market. So I think the only 2-3 companies will probably get impacted from this will be companies which are selling innovator drugs in the US, which probably could be a Sun Pharma, potentially could be a Wockhardt, potentially could be a Lupin, where, they charge very high prices in the American geography for an innovator product compared to what they charge for the same product in a European market or a Canadian market. And the reason for that being because America as a market allows you to freely price your product as long as it is patented. So from that standpoint, I think, if the innovator drug price negotiations happen at a more broader scale, other than just Medicare Part D, you are looking at the specialty portfolio coming under some pressure in terms of pricing and profitability.
Got it. The other thing that a lot of companies have spoken about, Aditya, is this whole GLP-1 thing. Diabetes, obesity, what have you. It seems that everybody's making a beeline for it. What have you observed here, and are there any company-specific impacts that can come about as a result of this?
Yeah. So this reminds me, Neeraj, of 2011 when the cholesterol drug atorvastatin was about to go generic, and there was a beeline for atorvastatin from every pharma company in India. So yes, it is a high volume drug. Yes, it is very effective. Yes, it is prescribed broadly by many physicians. But the fact is, if 10 people chase an opportunity, there is no longer an opportunity because it's an unbranded market. It will get commoditized. Pricing will get beaten down, and even the volume may be higher, the margins will be lower. So I am not so excited. Yes, there will be an intermittent 6-month, 1-year period where some players who will have a first mover advantage will make some money. But that 6-month, 1-year money is just one-time cash flow and cannot be given a multiple. And hence, I don't think GLP-1 will turn out to be such a material opportunity as many investors or many, onlookers are believing it to be.
Okay, so you Aditya, in effect, sorry, just trying to get this straight. You are saying that while these are moves happening, and please correct me if I'm phrasing it wrongly, but until the proof of the pudding comes about in the eating, let's not preempt too many benefits or losses as a result of these moves.
So what happens in a bull market, Neeraj, is that you tend to discount the positives and you tend to ignore the risks. I think that is what is happening today. But if the market changes tone, then you will see the risks getting pricing in more and the opportunities standing more as optionality values. So I think that's what we are looking towards.
Okay, fair call. The other thing that I noticed, and I'm taking a leaf out of the MedPlus results today, Aditya. I'm not asking you to comment on MedPlus individually. I mean, you can choose to, but I'm just saying that I saw that their margins expanded a bit, and despite store count addition, their store-wise margins also expanded because apparently our analysis seems to suggest that private label sales moved up from 14% to 18% YOY. Now, is this something that I'm changing tracks here from pharma companies to, let's say, healthcare chains or distributors or what have you? But do you reckon that this could fast become a dominating theme or dominant theme into the numbers of some of these chains, and would therefore that be a bucket that you would closely monitor / be inclined to invest in?
Right. So, Neeraj, white label sales from pharmaceutical chains is something that has baffled me for a long time. To my understanding of the Indian law, changing the prescription or switching the prescription from a prescribed drug to your own white label is something that the Indian law doesn't allow. That is point one. Point two, I don't think doctors prescribe the white label of a pharmacy chain because I don't think pharmacy chains promote their brands to the doctors. So I actually do not understand the legality aspect of this business at all. And for that reason, something that I don't understand, I don't invest in. So we stay away from such investments because I don't know how this white label thing plays out so you can do white label in electronics. There is no law in electronics that if somebody is searching for a OnePlus product, you cannot sell him an Amazon product. But in pharma, to my understanding, there is a rule that if there is a prescription saying brand A, you have to disperse as a pharmacist brand A. If you disperse any other brand, you are essentially violating the law, although the law may not be enforced today. But I don't understand how this happens in our market, and I don't understand the legality of it, which is why I stay away from such businesses.
Okay. So, well, and viewers, MedPlus should pull that up because the numbers look very impressive. Just want to mark that. Remember, Aditya is not talking about that one individually, so please bear that in mind. But just wanting to mark it, it's up 3% today. But Aditya is saying that there are a few things that an XYZ company might be doing, which are difficult to comprehend, and therefore better to stay away from something that you can't quite understand. Aditya is saying he doesn't understand. If you understand, good luck to you. Please go out and try and invest, of course. So keep that in mind. Okay. Now, Aditya, the numbers from divis were that big positive surprise, right? And maybe you will argue that it was not a surprise for you, but it was a surprise to the street at large. What I want to understand from you is that do you reckon that some of these companies are entering a bit of an up cycle because of capacities or contract manufacturing, so on and so forth? And could the market give high multiples to these businesses because they are cyclical, and at the upswing of a cycle, typically in the past they have tended to enjoy higher or even higher multiples than what they're enjoying right now? What would you do in such a scenario?
So, Neeraj, fundamentals of equity investing dictate that when the margins are at cyclical lows, you ascribe higher multiples so that you are closer to the fair value of the investment. And when the margins are at cyclical highs, you ascribe lower multiples so that you are closer to the intrinsic value of the investment. However, equity markets being what they are, when the multiples come at cyclical lows, the lowest multiple gets ascribed, which gives you an opportunity to buy. And when the margins go at cyclical highs, the highest multiple gets ascribed, which gives you an opportunity to exit. However, people get caught in momentum, and they think if a stock is going down, it will continue to go down, so they sell at the lows. And then the same thing, the opposite also happens when the stock continues to go up because margins are looking up. People buy at the top, and then they lose capital because the margins tend to mean revert. So this is just from a cyclical investing standpoint. Now, coming specific to something like a divis or any API player in India for that matter, the fact that divis or these API players tend to have a CDMO innovator portfolio will give their numbers some cyclicality in terms of quarter-to-quarter volatility or year-to-year volatility sometimes, because innovator products can be very lumpy in terms of the margins and in terms of quantum of sales that they give you. So one has to be very, very aware of, at what margin am I entering the stock, and at that margin, what is the multiple that I am paying for the stock. If the margin is on the higher side and the multiple is on the higher side, it is very likely you may make money for 6 months, 12 months if the margins continue to inch higher. But once the mean division of margin happens, the mean division of multiple will also happen, and it is very likely that you will lose capital over a medium term. Similarly, when you invest at a lower end of the margin in the down cycle, and you're paying a lower multiple than the average multiple of the stock, then you may lose capital for the next 1 or 2 quarters if the margins continue to go down. But over the medium term, you're very likely to make handsome returns because margins will mean revert and the multiples will mean revert with it, and which will give you a high return on your investment. So specific to divis, I'm not really sure how much they talk about their innovator pipeline and their innovator supplies and the sustainability of those supplies. And honestly, I don't think these CDMO players have enough visibility to talk about it, because the innovator knows the inventory situation. They don't know the inventory situation. So they honestly don't know how much sustainability of these cash flows are. But from an investor standpoint, I would rather invest when the margins are cyclical lows rather than when they're at cyclical highs.
Okay, point well taken. Aditya, where is it that you are most constructed now within this bucket? I mean, there is pharma, there is CDMO, there is API, and chains, diagnostic chains, and hospitals, of course. Where is it that you're most optimistic right now?
So most optimistic I am today in hospitals. There are a couple of stocks that we own where we feel valuations are just too cheap to ignore, and the business models are fairly sturdy and robust. And we continue to be extremely bullish on diagnostics as well, because as we had discussed in the past earlier, the volume growth in the brick and mortar diagnostic chains continue. The pricing power exists, and they are increasing pricing as we speak, and that will lead to operating leverage and better margins and better ROEs. So mind you, on the diagnostic side, we like to play the affordable players, and same goes for the hospital side. So we like to play the affordable guys rather than the premium pricing guys, because we feel the premium pricing guys are kind of tapping out their potential of margin growth, whereas the affordable guys, have far more runway for growth when it comes to their growth potential, because the affordable segment is just too large compared to the premium segment, which tends to be smaller in terms of volume.
Got it. Okay, and just one last question there, because when you saw the results as well and the commentary from Apollo Hospitals, there was a fairly constructive there. Is this, even if valuations are expensive, would the nature of growth and higher growth take care of some of the expensive valuations, Aditya?
It does. So if you look at hospital stocks, especially if you look at the Apollo stock price history, right? Let history tell you what will happen in future. So Apollo has had, or these hospital stocks do have 3-4 year periods when there is zero return, whereas the business continues to grow. Now that happens because the multiples in the period prior to those 3-4 years would have been taken to a level where the multiple just cannot re-rate any further. And therefore, the business has to grow and compensate for the multiple to come down over a period of time till it becomes affordable. And then again, the next leg of stock performance comes. So I'm very, very sure Apollo will do a great job as a company in terms of growth in top line, EBITDA and bottom line and cash flows. But in terms of the multiples, I think, a lot of that growth is getting discounted in the current stock price.
Okay. Aditya, such a pleasure talking to you. Thanks so much. It's a complex subject. You always simplify it for us. Really appreciate your time.
Thank you, Deepak.
That's the view from Aditya Khemka, fund manager at Incred Asset Management, on healthcare. We've got a lot of things moving around, and that's a sector that's turning out to be fairly defensive in that a lot of stocks, even after numbers, have done reasonably okay. But the market's not doing all that well. Just before we wrap up, quick mark there. The small caps are reeling under some serious pressure. So bear that in mind. 2.21% lower for the Nifty small cap 250. That space is really seeing some serious selling in the session today. Not that large caps are spared, just that mid caps are cracking big time. Wrap it up on this leg of Talking Point. Thanks so much for tuning in.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Traffic 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize.
Hello and welcome. You're watching the FNO show, and over the next half an hour, we will take you through all the action or the lack of action in the markets. Most of it seems to be on the sell side this morning. Agam, we started off okay, but the pressure is obvious. 23,800 hasn't been held out, and I think more importantly, we are firmly favouring the declining stocks.
Samina, the broader markets are turning out to be a nightmare now. And I'm not understating, because until yesterday and day before, we were thinking that maybe there'll be a little bit of respite, but that respite is not coming through. And in fact, we're seeing a round of follow-on selling coming in. So the broader markets are certainly taking it up the chin in very, very badly. If you consider just the Nifty, now we're well off 24,000. It's done. It lies in its wake. And the Bank Nifty too, we were expecting a little bit of a real short covering, at least earlier on in the session, at least in the first half an hour, but all that strength has been sold into right now, and it does seem like we're in for a little bit more of a challenging time right now at the moment. Even if you consider the broader markets, that's where the real pain lies. Everyone who's invested in the cash markets, a lot of these stocks are down anywhere 20 to as much as 40%, even 60% in some cases, right from their peak. So a lot of the gains that you have made through the course of this entire financial year have, to a certain extent, come off substantially. I'm not saying that a lot of these gains have been completely wiped off, but there will be instances where your profit numbers have come off significantly. But let's go across to Charu, who is in fact at the Swiggy conference. Charu, over to you.
In line with your listed peer, do you plan on beating them in this financial year, and how?
I think the answers for all of these are going to be who takes more care of their consumers, who's innovating on behalf of consumers, and that's exactly what our plan will be. To understand, latent needs, to understand express needs, to solve for needs that even consumers didn't know they had. I think all of this is going to be important as we think about just really, really strong growth in the category, and that's what we're gunning for over the next few years.
Thank you, sir.
Hi gentlemen, congratulations again. This is Shilpa here from CNBC TV 18. I wanted to understand currently your food delivery is at a steady state growth, at a comfortable growth level, and quick commerce we're seeing at a very high growth level, right? So over the next maybe 2 to 3 years, what is the kind of GOV growth rate that you're expecting? If you could give us a sense for food delivery also, and what is it that you're expecting for quick commerce as well?
Yeah, so see, I think we mentioned about our food delivery business having turned profitable and at a very good pace of growth. It's still an early stage for India's food delivery industry. If you look at the overall size of the industry, and the online food delivery industry, there is a pretty massive scope for us to continue growing into this larger macro factors that will continue to aid that growth. Talking about the quick commerce segment, we are seeing a pretty robust consumer acceptance to larger categories, larger selection. The platforms that are currently doing a good job on speedy deliveries have to also been able to the consumers are reimagining the category in terms of what they would like to associate or want to purchase from these quick commerce platforms, and we are trying to do our best in terms of giving them more assortment, faster delivery times. So it's an exciting phase of our growth. I think we will continue to give more color in our quarterly earnings call.
But I'm looking at a slight some color, a high double digit, above 10%, above 15%, above something.
I think,
now that you're listed, I'm sure it's something that you can share with us.
See, our industry report suggests that we are looking at a 60 to 80% category growth over the next 4 years.
This is for?
For the industry, right? So there's this is for the quick commerce business. So we are looking at pretty healthy growth rates, and we will hopefully beat those growth rates.
All right, thank you.
Couple of things. First of all, food delivery business is broadly a oligopoly, and when it comes to quick commerce, we have new players coming in.
Yeah.
Obviously, Blinkit is there, Zepto is there. So how do you really look at market share? Because obviously growth is there, but in the food delivery business, we have seen you lose market share. So when it comes to food delivery business, how do you see your market share? Do you think there are legs to improvement there?
Yeah.
Number one, and number two, for the quick commerce business, the retailing business, how do you see it given the fact that new players are coming up quite aggressively and they also have quite good funding, lined up?
Cool. Thank you. So firstly, as for the first question on food delivery market share, again, we're weeks away from our earning call where we'll talk about the progress we've made, how the business has moved on. So maybe that's a great opportunity to go in more specific. And the second one, the question on quick commerce and competition, look, I think this is one of the largest categories that India Internet will have seen in a long time. So if it is a very large category, then market size leads to market structure. So we think that there will be many players competing, but as we've maintained, I think right now, if you look at the overall category size and where we're at right now, we're 10-15% done. And a lot can unfold in the next 4 or 5 years depending on how players execute, how players understand consumer needs, and that's what we're playing for.
जब IPO के लिस्टिंग के दौरान आपने कहा था एकता फूजी बिजनेस, आपने कहा था कि आपके बहुत ज्यादा क्विक कॉमर्स को एक्सपेंशन के प्लान्स हैं, डार्क स्टोर्स खोलने के प्लान्स हैं, तो अगर आप बता सके कि अगले 1-2 सालों में आप कितने डार्क स्टोर्स खोलने वाले हैं, किस तरह आप एक्सपैंड करने वाले हैं, और साथ ही अभी जो फसाई का नजर है क्विक कॉमर्स के ऊपर, उसके ऊपर आप क्या करेंगे?
तो एक तो जैसे हमने ऑलरेडी हमने दिखाया था कि हमारे जून में 557 स्टोर्स थे और वी हैव कंटिन्यू टू इंक्रीज द नंबर ऑफ स्टोर्स और सिटीज भी हम एक्सपैंड कर रहे हैं. तो इस साल हम जो स्पेसिफिक गाइडेंस है कितने स्टोर्स होंगे वी विल गिव इन आवर फर्स्ट अर्निंग्स कॉल. With respect to,
if you could just give us a number.
See, as I said, industry is growing at 60 to 80%. तो आपको मानना चाहिए कि इतना तो ग्रोथ मिनिमम होगा ही. Right? Now coming to the FSI question, I think we are compliant. हमने काफी अपने systems और operations को काफी सशक्त किया है ताकि जो हमारे कंट्री के जो रूल्स है, रेगुलेशंस है, हम उनके अंदर काम कर पाए. तो basically it's a advisory. These are rules that we are continue to follow. We will continue to strengthen those rules.
Good morning, everyone. I am Pratik from PTI. So recently we are seeing the growth of zero commission based startups, particularly in the food delivery. So what is the company's strategy to counter this?
Actually, we're not familiar with these zero commission percentage startups. Is there any specific names that you want to talk about? ONDC is, of course, a different paradigm. If we're talking about ONDC, I think, look, as a company, every category that we operate in is incredibly dynamic. The landscape keeps changing every few months. And our job as a company is to keep making sure that the paradigm that we have is still serving consumers the best, because consumers run the business. So the moment there is an operating model that is possible to serve consumers even better, then we'll be all over it.
Mr. Macheti, the CCI is probing if the company had used exclusivity arrangements, specifically in the food delivery business, and there were any violations in the competition laws. So what is Swiggy's stand on this, and how can you update on the same, and do you see any kind of an impact due to this? My second question will be, going ahead, what are the goals and plans for Instamart?
So maybe on the CCI question, I can take that. So what has come out in the media recently is just that there are certain initial observations with respect to business practices. We are not in receipt of still the detailed findings, and when we will receive them, we will appropriately look at the. So it's a very initial stage of the inquiry, but we are very confident of the business model that we have followed, that they do not contravene any of the existing laws in the country, and we're very confident on that. On coming on Instamart, I think we have talked about the industry growth rate being very, very solid or stellar for the next 3, 4, 5 years. The consumers are continuing to expand their requested selections on the platform. We see a lot of null searches for newer category, and we have continued to expand our overall range of SKUs available on the platform. Even if you look at the last 12 months, we have more than doubled our available number of categories as well as the number of SKUs available on the platform, while reducing our speed of deliveries from close to 17 minutes to 12 minutes on a national average basis. So these are solid inputs that are going into growing the category, and we will therefore continue to invest behind the growth of this category.
अनुराग जोशी स्वदेश से सीसीआई ने एक जांच शुरू की है जिसके तहत वो ये पता लगाने की कोशिश कर रहे हैं कि जो एक्सक्लूसिविटी अरेंजमेंट्स आपके फूड डिलीवरी बिजनेस में है तो उसमें कहीं कोई उल्लंघन कोई वायलेशंस हुए हैं और उस पर कंपनी का क्या स्टैंड है और इसके चलते कंपनी के ऑपरेशंस पे कोई इम्पैक्ट हो सकता है। दूसरा सवाल मेरा ये है कि इंस्टामार्ट को लेकर आपके क्या गोल्स हैं, क्या उम्मीदें आप आगे बना रहे हैं इस बारे में।
तो सीसीआई के ऊपर जो एक कंप्लेन हुई थी बाय रेस्टोरेंट एसोसिएशन एंड सीसीआई ने एक प्रिलिमिनरी एक फाइंडिंग और ऑब्जर्वेशंस कुछ पब्लिश किए हैं। वी आर नॉट स्टिल इन रिसीट ऑफ द फाइनल डिटेल्ड ऑब्जर्वेशंस। तो वंस वी रिसीव देम वी आर गोइंग टू एग्जामिन कि क्या क्या उन्होंने उस ऑब्जर्वेशन में कहा है। हमारे अनुसार हमने जो कंट्रीज के लॉस है हम पूरा उनको फॉलो कर रहे हैं। हमारे जो बिजनेस प्रैक्टिसेस है जो हम अपने रेस्टोरेंट पार्टनर्स के साथ रिलेशनशिप रखते हैं they are in complete compliance with the laws of the country, and at appropriate time we will review them if we have to strengthen or any of that, and we are fully committed to strengthening of those. With respect to the quick commerce business, your question regarding the growth and our growth plans, we have continued to expand our geographical footprint. We have also continued to expand जो हमारा नेटवर्क स्टोर का नेटवर्क है। हमने काफ़ी शहरों में इस साल नए शहर भी हमने ऐड किए हैं। हमने काफ़ी स्टोर्स भी ऐड किए हैं बड़े शहरों में। अभी हमारा आप देखोगे तो डिलीवरी टाइम लास्ट ईयर जो 17 मिनट था अभी कम होके 12 मिनट हो गया है। तो हमने बड़े शहरों में और नए स्टोर्स खोले जा रहे हैं। एक हमारा और स्ट्रैटेजी रहा है कि हम बड़े स्टोर्स भी खोलें। तो जो एवरेज स्टोर होता है वो 3,500-4,000 स्क्वायर फीट का होता है। एक और जो हम अभी एक्सपेरिमेंट अभी जो कर रहे हैं और रोल आउट कर रहे हैं वो 8,000 से 10,000 स्क्वायर फीट के स्टोर्स हम ऐड कर रहे हैं, जिससे हम कस्टमर्स को और ज़्यादा सिलेक्शन दे पाए और जल्दी दे पाए।
So, sir, my last question to you. Thank you for having the patience. So, as my good friend just spoke about the CCI observations, and recently FSSAI also had a meeting with a lot of quick commerce and other entities talking about how 10-minute delivery system is in itself complex, and if someone is not able to execute it properly, they should not go for it. And then there is issue about expiration dates and a lot of things that are happening. So. Firstly, I would like to know how do you plan on, addressing these things, and do you fear that this could, give some bad reputation or fear in the minds of the consumers, affecting the market share, because it is something that needs to be protected as well?
Sure. So I think where we have just got is the advisory of the current on the FSSAI matter. It's just the advisory on what are the amount of say minimum shelf life that is required to be sold to consumers. As a platform, we are fully compliant. Our IT systems are very robust. That ensures that less than the minimum required shelf life does not go in the hands of the consumers, and we will continue to strengthen them. On the CCI matter, as I had mentioned that these are preliminary findings. We are still not received the detailed observations. Once we receive them, we are going to examine the specifics in that matter. But at least we believe that we are fully compliant to our business practices and do not have any contravention to the existing laws of the country.
All right, that's the management of Swiggy telling us about all the plans that was there on the anvil. And of course, with the way things have moved on Swiggy specifically, if we can very quickly take a look at how that stock's doing. So a 10% premium to its issue price currently. It's turned out to be a better listing than what we were expecting, because we were actually expecting a flat listing, but we're looking at a 10% up move there with respect to its issue price. Anyway, let's move on and talk about the futures and options space, perhaps a lot more pertinent now. And we have with us Bhavin Mehta. He is the Director Research and Derivatives Strategist at at Dolat Capital, joins us on the show right now. Bhavin, good morning and thanks for taking the time out. It's a tough market right now. How are you looking at things panning out here?
Hi, good morning. So yes, definitely last couple of days we have seen a very sharp reversal in market. Nifty breaking 23,800 on a closing basis will be something that would add pressure to the market. Now there are various support zones on the downside, but the way the sell-off is progressing, specifically in the high beta space, definitely the caution approach is what we continue to observe from the participants. And in fact, in this sell-off, the volumes continues, specifically on the cash side, continues to remain on the lower side. So that is something of a concern. Watch out for level of 23,500 and 23,200 on the downside. Anticipating high probability, if we close below this level of 23,800, we would retest that particular level on the downside. And as far as Bank Nifty is concerned, again, today, post the initial strength that we had observed, good amount of sell-off has set in, and couple of stocks, particularly something like HDFC Bank or ICICI Bank, they have not corrected the way markets have witnessed a drawdown. So watch out for these two names in particular, where there is a potential of further drag on the markets going forward.
We also have Ajit who's joining us. Ajit, it's a very tough market this morning. We thought 23,800 would hold, but that's been given away, and how? Threatening 23,700 now on the downside. Is the Nifty in a no trade zone?
Yeah, good morning, Samina. So, yes, it's a challenging market, and after almost 2 weeks of a struggle or a kind of a distribution that we were seeing in the market, it's finally given in, and we are again slipped below the previous swing low. So I doubt, Samina, that 23,800 had any significance, because on the closing basis, 24,000 was a mark basically which markets were defending, and we decisively breached that mark yesterday after the underperformance from the banking heavyweights. So now the next level is the long-term, moving average, 200 days of exponential moving average, which lies around 24,540 area. That's the major zone that we have for the index now. And banking, particularly because till last week, in fact, for the initial sessions for this week also, we were seeing some sign of alignment between IT and banking. So that raised hope that we might make an attempt of recovery and inch toward 24,500, but it turned out to be otherwise, and now we are seeing profit taking in both IT and banking space as well. So all indications are in the favor that we are going to test 23,540 first before making any meaningful recovery. And banking is something that one should keep a close eye on, because sustainability below 50,900 may result in further decline towards 50,000 and maybe lower. So both the indices having a negative approach. So sell on rise is something that one should maintain.
Sell on rise is the word coming in from Ajit. Ajit, again, stocks on your radar this morning. Do you have any buys or do you have any sells? How are you approaching them stock-wise?
So Agam, I guess, IT is still comparatively better, and the way we are seeing, especially the IT heavyweights holding strong, one can continue to look to accumulate on depths. So Infosys is one bet which one can look to go long. Even during this corrective phase, and 1825 is something that one should maintain as a stop loss for 1930 as a target zone. At the same time, we are seeing distribution or fresh breakdown some of these names in the capital goods space. So ABB is one such name, wherein we have seen fresh breakdown, and 6540 is what we are eyeing as a next target zone. So with stop at 7,000, one can go short in ABB at current levels.
ABB buy Infra, and I believe Bhavin as well as a call on an IT stock, and this one's TCS. Bhavin, you want to walk us through TCS, the buy call there, and any sell trades that you have?
Yeah, so as Ajit has already pointed out, that IT as a sector continues to hold forte. We believe that watch out for TCS as well. The stock has closed about 20 DMA with a very strong momentum, along with good amount of volumes. Our sense is that as long as stock holds above level of 4090, watch out for level of 4350 to be retested on upside. Stock is currently quoted in the range of 4150, 4160, so makes a decent risk reward trade at this point of time. Second trade is for Dr. Lalpat Lab. What we are observing is that the stock has witnessed a breakdown earlier. Post that breakdown, which was marked by an extremely high OI volume delivery markup, we have seen almost 15 days of consolidation for this counter, and once again it is giving you a fresh breakdown below 3000 level. Our sense is that eventually this stock should move closer to 2750 to 2800 on the downside. One should keep a strict stop loss on closing basis around level of 3125.
Right. Well, there you have it. There was a handful of calls coming in from our experts in what's turning out to be a very, very tough market to deal with. But let's talk about maybe one or two counters which are in focus right now. Pardon me. Ajit, let me talk to you about Trent because what we've seen is a little bit of a arresting of the sharp correction that we've seen in Trent of late. And again, I'm sure that everyone who is sitting with a little bit of cash, or for that matter, everyone who wants to potentially enter the future space here as well, they would be tempted only because there's been a little bit of consolidation. At this point in time, do you think it would be risky to take a long position, or do you feel otherwise? What is your reading on Trent at the moment?
So Agam, it's the first phase, I would say, that decisive corrective phase in Trent after the phenomenal surge from 1000 to 8000. Because earlier we used to see more of time-wise correction in the stock, and it was strongly holding the short-term averages, which clearly indicates momentum on monthly, weekly, on multiple time frames. So this kind of corrections now, I feel that price-wise, it might be over. So maybe close to around 6,000, 6,080 is something that we have multiple supports. So it might hold that level. But time-wise, at least, it should spend at least a month or two around the current area before making any meaningful progress or any base for the next leg of the year move. So one should not hurry into a trade. If you are planning for accumulation, then it is okay. But derivative trades means leverage position at current levels for aggressive upside is something seems capped. Because short term around 69, 80, 7,000 zone, I expect the stock to witness multiple resistances also. So the risk reward is also not favorable for short term trades.
Well, that of course is Ajit's view. Bhavin, you want to come in on Trent and Britannia for intraday only? And the reason I ask is after the last 2 days of being quite tough for Britannia, it's trying to consolidate. Now, we do understand in a market like that, even if you get 1 to 2, maybe 1 to 5%, it's not too bad a trade. So would you bet on Britannia or Trent intraday?
Okay, so looking at the structure for Britannia, which has witnessed a very good amount of drawdown over last two trading sessions, it is once again back to the mid-May kind of a consolidation zone. We had seen good amount of accumulation at this point from where it witnessed a move towards a level of 6,500 on upside. So definitely at current level, risk reward wise, it looks an attractive bet. High probability in an intraday kind of a move. We may see a move closer to 5120, 5130, which again remains a very crucial zone for someone who has already written down aggressively on the call side. So if you look at call side, 5100, which is currently quoting around 77, 78, we have seen some aggressive call writing earlier. So this level of 5120, 5130 should act as a resistance point. If it breaks out about that, I'm anticipating a very strong move on upside. But till that time, that level remains a crucial supply zone for the stock.
And Bhavin?
Yeah, as far as Trent is concerned, view is that we believe that high probability stocks should ideally retest that level of 6,000, 6,100 first before witnessing any major move on the upside. And the recent drawdown on the stock started post that inclusion into index. So I am bit cautious with regards to trend. In fact, I will be looking for a move if it extends towards level of 6,700, 6,800. We'll be looking to pair exposure rather than building fresh position at this particular price point.
All right, thank you both for joining us and taking us through your views on the markets. Of course, it's a day where we're seeing further selling, follow-on selling, if I can call it that, specifically in the broader markets. But with that, let's shift focus to the commodity space. We have Dinesh Somani. He's a co-founder of Pro IntelliTrade Services, who joins us on the show. Dinesh, good morning. Thanks for taking the time out. Your view on gold and silver now. Do you think that there could be a little bit of recovery, or are you bearish?
Yeah, good morning. We've seen prices decline almost by 5,000 rupees from 79,700 to 74,700 levels, and also silver from lakh rupees to 90,000 rupees, almost a fall of 10,000 rupees. The dollar index is trading at a 6.5 months high, almost at 106 level, and that is cracking the prices down heavily. Secondly, when Trump came in, he said that he just wants peace and he would end up all the wars, and that declined the premium in gold and silver prices. But almost the prices have fallen by 5,000 rupees, and we expect a slight recovery as far as gold and silver is concerned. A downside level of 74,880, 74,920 should be a good buying level for gold on an intraday basis. Upside potential around 75,200, 75,450 levels. Stop loss to be maintained below 74,400. On a similar basis, silver, we expect a retest of 89,600 levels around. That could be a good buying level. Upside again 9,700 should be the target. That's again a resistance, and stop loss to be maintained below 88,900 levels. So both buying call, just a pullback rallies as of.
Dinesh, what about crude? And I don't know, have you started tracking Bitcoin as well now that it's become more valuable than silver?
Actually, Bitcoin market cap has gone past the market cap of silver now, and it's traded almost the all-time high of 90,000 approximately. A dip could be possible around 82,000. Hello.
Let's continue with Bitcoin and crude.
Yeah, a dip could be possible around 80,000. Again, prices could rally to 92,000 as far as Bitcoin is concerned. Crude, as far as the China stimulus package was concerned, that was not attractive and did not attract buyers as far as crude is concerned. The demand-supply mismatch is still taking place, and I expect a pullback rallies probably around 57.60 levels. Upside at 58.40 and 59.20 levels. A range-bound activity. Stop loss to be maintained below 5,700 rupees level.
Thank you, Dinesh, for that. That's a buy on crude, a sell on gold and silver, and Bitcoin, which is clearly the big call, the Trump trade worldwide. But that's all the time we have on this edition of F&O Spotlight. Thank you, Agam. Thank you for watching us. Of course, stay with us because we've got the small and mid-cap show up next.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 3.
Hello and welcome. You're watching the Small and Mid-Cap Show. Before we go into market action, there's been a little bit of a recovery from the day's low point, which is a little bit of a relief if you're a bull on the street. We are comfortable about 23,704 now, but still away from 23,800. That is, of course, an important level technically for the bulls. So it's volatile in a difficult range. But there are a few stocks that are holding the markets together. Counters like Trent and Britannia are trading in positive territory. But let's move on from the markets to a profit exclusive. National Housing Bank is set to issue its first long-term bond issue in 10 years. Let's bring in my colleague Shubhana with more details on this. Shubhana, it's over to you.
Yes, so the corporate bond market is actually about to witness its long-term issuance by National Housing Bank in about a decade. Now, National Housing Bank actually plans to raise up to 5,000 crores through this 10-year bond issue, and they've invited bids for the same on Thursday. The issue size would be 2,000 crore rupees. The base size would be 2,000 crore rupees, and the green shoe option would be 3,000 crores. While the company is actually expecting to issue these bonds at a coupon of 7 to 7.5%, but the market is expecting them to issue these bonds at a coupon of 7, 10 or lower than that. Now, the last time when NHB had actually tapped the bond market was in 2014, when they had come out with a public issue of tax-free bonds. Those were long-term bonds which had a maturity of 10 to 15 years. So this is the kind of issue that people are actually kind of waiting for. NHB has also tied up with LIC and EPFO as investors. So the pricing of this issue, as it is coming after a very long time, that would be keenly watched out for.
This is going to be something to watch out for, given the action or the lack of it in the corporate bond market. Shubhana, thanks for joining us on that. Well, let's move on to the management of Gujarat State Fertilizer. They reported numbers, and of course the markets have reacted to that this morning. But we have with us SK Bajpai, Senior VP Finance and CFO of GSFC, now joining in. Good morning, Mr. Bajpai. Thank you very much for taking out the time to talk to us. I want to start with the revenue decline that you've seen in this quarter. Revenues are down over 15% on back of lower DAP and urea volumes. Could you explain to us the factors that are behind this, and are you expecting a significant recovery going into the next few quarters on the trading volumes of DAP and urea?
Yeah, right. The turnover and actually the volume has been reduced in the Q2 and H1 also by 13% and 6%. This is mainly due to the reduction in subsidy rates, because the revenue is combination of the retail prices and the subsidy received from the government. So in last year, the same period, the subsidy rates were around 24 to 30%, 38% higher for the phosphatic fertilizers. But during this period, the rates were reduced, so that's why the revenue is slightly lower. However, coming quarters for Q3 and the whole year, there is similar subsidy rates will be there, because in the reduction in the rates was announced with effect from October 23. So for third and fourth quarter, the same subsidy rates will be there. And as far as the import of the fertilizers like DAP and urea is concerned, we have already made contact with the foreign suppliers for the DAP, as this DAP is in short supply in Indian market. So in quarter 3, we will be importing around 1,25,000 metric ton of DAP and urea as per the allotment given by the government of India. So there is there will be available fertilizer availability will be better in the quarter 3 and quarter 4.
Good to hear, sir. Also, your margins have improved significantly from 7.6 to 10.8 on back of lower raw material costs. Now, is this a one-off, or going into the next couple of quarters, the margin range is moved upward closer to maybe 10 to 12%?
I foresee that the margin will remain in the same proportion, because the raw material rates are again started to climb, like ammonia, natural gas, and the phosphoric acid prices are in the increasing trend. So I don't foresee any further increase in the margins. And as such, the quarter 4 and quarter 3 is the end of the fertilizer industry season. So the margin will be remaining same as in the quarter 2 or first half of the current financial year.
Okay, so in that range of 10.8, which is still a massive uptick from what we'd seen in the last year. You know, I want to talk a little bit more about DAP and urea, because the margins there are currently negative. Urea margins are also under pressure from what I understand. Are you expecting this to turn around in the near term, or this could still be a longer drawn process here, till of course there are changes at a more macro level?
No, actually, in case of DAP, the subsidy rates were quite low, and the international pricing of the DAP was hovering around $640 per metric ton. So that was the really cause of concern, and the government of India has been kind enough to increase the subsidy by giving a special package of 3,500 rupees per metric ton in case of DAP, which is applicable up to the month of December. So that's why we have tied up this DAP import from the foreign suppliers, and there will not be any loss. If there is any loss, that government has already assured us to compensate that loss in case of DAP import. As far as urea is concerned, in case of GSFC, we are not having much losses, but the urea import as such is less in comparison to the earlier years, because of the starting of the 3-4 urea plants set up by support of the government of India, HURL. So the less import of urea is foreseen in the near future.
And what will that do to your business, sir? Because globally as well, there are people are talking about and considering replacements to DAP and urea. Then what happens going ahead, and how does that impact you, and what are you doing to negate that impact in some ways?
So mainly we are producing DAP in our Sikka unit near Jamnagar, Gujarat. So there are 3 tanks, but we have the option to produce either DAP or other NPK grade of fertilizers. So till the time phosphoric acid prices and ammonia prices are not cost effective to produce the DAP, we are switching the production to NPK grades and the APS in case of our Sikka unit production facilities. But in urea, there is no problem. We are producing in Fertilizer Nagar, so we have the old urea plant 1 and 2, and urea 2 plant is we are upgrading, and that upgradation will be completed by the year end. So there will be energy saving and much more cost effective urea production will be there in our Fertilizer Nagar complex.
Right. So I want to get a quick update from you as well in terms of your recent project timelines. You do have an ongoing project, which is the Urea 2 revamping project, phosphoric acid project, and the solar power projects as well. When can we expect the completion of these projects, and when will they start contributing to your top line?
Yeah, all these projects will be completed by the year end. Urea 2 and this other sulfuric acid 5 project, and the one smaller solar power project. All these projects are slated to be completed by the year end, and we will be getting the production and whatever the cost effectiveness in the production we will be getting. But as such, this is the replacement of our earlier plants, and it is the captive consumption. So there will not be much change in the top line, but certainly improve the bottom line.
Well, lastly, sir, what is the expected contribution from the sulfuric acid, SAV and phosphoric acid projects to GSFC's revenue and margin structure? Any potential export opportunities here? And of course, then what does that do to your margin picture?
The sulfuric acid is for own consumption because sulfuric acid is used as a S content in the NPK grade of fertilizers. So we are not presently selling any sulfuric acid in the market. But after commissioning of the sulfuric acid 5 project, if there is any extra additional available sulfuric acid is there, we will certainly approach the market for the sale. As far as phosphoric acid is concerned, that is also for the captive consumption to produce the DAP and other NPK grade of fertilizers. So these all the plants are as a backward integration for production of DAP, NPK and other grades of fertilizers for the company.
Right. Thank you very much, sir. It was a pleasure talking to you and understanding a little bit more about what's happening in the business and for the company. And of course, a complete picture on urea and DAP as well. Thank you. Good talking to you this morning. Well, the management indicating that margins will be maintained at that elevated 10.8% on back of lower raw material costs. Trading volumes of DAP and urea is what's under pressure, and that may continue for another quarter at least. Well, from one company to another, TV Chaudhary, MD of Premier Explosives now joins in. Hi, Mr. Chaudhary. Good morning. Thanks for talking to us. Mr. Chaudhary, how significantly has the current supply chain delays impacted your margins, and are we expecting this to improve or turn around as we go into the second half of this year?
Yeah, they have some LDs are expected, which are, but we are requesting the government to waive off the LDs because of the present conditions and then which are beyond our control. So yeah, I'm not sure whether LD will be applied or we'll be able to come out. If it is applied, it will be in the range of 10% for the particular order, not for the entire turnover.
And how likely is that expected in terms of timeline? Any indications?
The supplies have to be completed by the end of this financial year with the extended delivery date. Now, whether that will be with LD or without LD, after completion of supplies, we can approach them and get it.
Right. Just let's talk a little bit more about and elaborate on the emergency procurement orders for shafts and flares at all prices. Will this continue to affect your margin in the near term, or will prices be adjusted to, and hence improvement on margins can be expected?
Yeah, the improved margins can be expected because as we start producing more and more components in the country rather than importing, the margins are expected to go up. And the prices also, these prices what we are supplying almost 3 years old prices, we expect an increase in the price also, which will give us a little better margin.
And also the new orders that are coming in at better margins, sir?
No, new orders, they are yet to open the RFPs. We have quoted, we have participated. Yeah, definitely we are asked for better margins.
So moving parts, right? Your EBITDA and your revenue has also significantly declined YOY for a couple of factors that you already mentioned. But where do you see this stabilizing? And are you doing anything internally to improve operations, which will then affect efficiency and hopefully have a positive impact on your bottom line?
So the turnover is not depleted. It is 28% increase on the year-on-year. That is last half year. So EBITDA, yeah, to some extent because the delays in the deliveries and then whatever this end of the quarter, that is the half year end, the stocks which are there, we could take the value early on the cost price rather than the selling price. But they are all complete and ready for dispatch. In fact, this is the current, that is third quarter, they will all come into the turnover and the profits.
Sir, your order book is 827 crores, which is almost 3x of your FY24 revenue. In terms of timelines, how do you see this convert to revenue? And what are the timelines for completion? So we get a sense of what we can expect in terms of guidance for your top line growth.
See, these are one of the bigger orders to be completed in 5 years. That is the service contract. But other than that, mostly they are of 2 years period. So we expect to complete this in the coming 1.5 year time. But other orders will be adding to this where we are participating and we are quoting. So that's the present plan.
You know, one thing that is a strength and also risk for Premier Explosive is that 88% of your order book comes from defense. Are you trying to work with sort of reducing the dependence on one significant vertical, working on a change in product mix or a mix of clientele which goes beyond defense, only in order to reduce the dependency and the risk associated with one sector, right?
See,
We're having a little bit of a problem with Premier Explosives.
yeah, the raw
audio, but
material
yes.
prices for
Yes, sir. I just wanted
raw
to get an
material prices.
understanding in terms of your order book. 88% of your order book comes from defense. Are you trying to sort of, widen and diversify your client base? Because with 88% coming in only from one industry could pose a risk.
No, we are not planning to get out of the industrial explosives business. We will be very much there. Depending on our profit margins, 3 years back, we decided to support more and go get more support and then work more on the defense. But now we have overcome that, and now commercial explosives also, now the margins have improved. So again, we are into the game of commercial explosives. There is no plan of getting out of that business. But yes, 3 years back, we consciously reduced our exposure to that industry, but we are back into it.
We would get a better product mix or client mix, say by next quarter?
Yes.
Okay. Sir, also, let's talk about exports. We didn't allude to that at all. What is the export business looking like, growing at, and where do you want to take it in the next few years?
See, we have two parts of export business again. One is the industrial explosives, another is the defense rocket motors and all those. Now they are almost, defense exports are 60 to 70% right now are defense exports. And around 40 to 30%, 30 to 40% is industrial explosives. Our previous industrial explosives customers all are continuing, and we are still servicing them, and we hope to continue that.
So I want to talk to you about rocket motors for missiles. You've maintained that there should be significant revenue coming in from rocket motors for your new missile projects. Give me an update on these projects. What is the sort of timeline and revenue contribution potential that there is from this? I mean, quantify this for me.
Yes. We are expecting at least another 100 crores of orders in pipeline in terms of rocket motors for Indian defense purposes and also for the export requirements. But parallelly, we are working on other projects where, we are also into design and developing. So there are other rocket motors which are in development and design, which are expected to join in the production line by the next financial year. So whatever increase we are expecting in the coming year, that is crossing the 500 crores and all that we are expecting from this area.
Also, the other business that I want to spend some time talking to you is on your 40 ammunition and RDX exports. Any progress being made there on expanding the product portfolio to include 40 ammunition and RDX exports? Any specific markets that have shown interest? Any conversations that have happened?
Yeah, RDX exports we are doing already, RDX and HMX. Only thing is present capacity, we are not able to export much because of our own internal requirements we are meeting from that. But I indicated earlier also, we have taken up the expansion of our RDX and HMX and their compounds production plant. The project is under construction right now, and I expect by the end of this financial year, it will be ready for pilot scale trial production. And next financial year is, I think we should be exporting from that new facility.
Sir, also with the focus that the company has on backward integration, you want to share with me any plans there and a quick update? And also, what sort of capital are you allocating to this backward integration, and how do you plan to fund it?
As on date, we have a plan of going mainly today. One is I told you, RDX and HMX as a raw material. We are expanding, and then that funding is already available to us. And other than that, other area what we want to expand backward integration is the TNT. TNT is one of the important explosives used in defense. So we have plans of going for a TNT plant. And also once we have the TNT plant, then again we go for forward integration, that is production of artillery ammunition where TNT is the raw material used. So I can give together what is the plan. We have a plan of going up to around 200 crores of Capex in the coming 2 years.
Well, just one quick question in terms of, raw material prices as well. Now, those have been fluctuating and have a direct impact on how operationally the company does. Have you got any hedging strategies in place, sir, to ensure at least there are not big moves that, you get hit by quarter on quarter?
See, as you know that we are in the defense business, most of the turnover is coming from defense. In defense sector, we are not finding any big fluctuation in the raw material costs or input costs. They are stable. Other than the raw material, the increase is only in the manpower costs and other rather than the raw material.
Right, sir.
And in industry,
right,
yeah.
sir. Please continue.
Yeah, in the industrial explosives sector, the prices, Coal India and Singareni prices are linked to the price escalation clause linked to raw material fluctuations. So that is taken care now, whereas which was not there 3 years back. That is the reason now that area is looking a little better.
So just one last question, just looking ahead, what is the sort of growth that you've set out for yourself internally? What sort of growth momentum would you like to maintain or you see Premier Explosives grow at in the next 2 to 3 years?
The present plans, at least visible, our plans are we expect to cross the 5,500 crore turnover by the year end 25, and have target of reaching 1,000 crore turnover by the 2030.
Oh, good luck with that, sir. Those are ambitious targets, but hopefully, fingers crossed, those should be achieved by you. Good to get an understanding of what's happening at Premier Explosives and, of course, explosives and the outlook for the company going ahead as well. It's been a solid quarter for them too. Well, from one to another, Premchand Devrak Konda, CFO of Electronics Mart, now joins in. Good morning, sir. Thank you for joining us this morning. Let's try and understand what's happening in the business, Premchand. Same-store sales growth was negative 0.6 for the second quarter. What led to this decline, and what are we expecting, or what should we expect going into the next few quarters, given that there's a festive demand impact as well that would be visible?
Yeah, good morning, and thank you very much for having me on your show. See, this quarter is one of its kind. Like what happened during this quarter, the monsoon effect was significant. There was heavy downpour in the regions where we have been operating, and it reduced the footfall drastically. And second is the Shraddh period that is considered to be inauspicious, and obviously there is reduction in the footfall. So these two things mainly contributed to the reduced SSG, but the scenario is not the same in the upcoming quarters.
Okay, then let's talk about what is expected then in the next couple of quarters. Should we expect a degrowth turning into growth? And if yes, what is the sort of range growth or internal expectations you're setting out for the team in terms of same sales growth?
See, SSG will be close to 8%. That was targeted, and which we have been working towards it. And the top line growth at the company level, it would be 15% for the year, and that is easily achievable.
Okay, so net retail sales have also dropped per store by 15%. The same reasons apply here as well, the fact that you had Shraddh and the fact there was a heavy monsoon?
Yes, these are the two factors. And second thing, like when there is no footfall, so obviously that high-end television sale will also go down, because until and unless customer have the touch and feel, so they don't go for the purchase. So that is one of the reasons. Right. And also even the large appliance sale also little bit reduced as compared to the earlier quarters. And that is in fact evened out during the festive season. So we started from 3rd of October, and we could see decent growth in our festive season sales.
Right. So in terms of early signs that you're seeing right now for the next quarter, the festive season is partially behind us, but the wedding season is still in full action. Are you feeling there's already a sense of improvement, a big improvement in terms of footfalls, etc.?
It is quite encouraging. We could see double-digit growth in the recently completed festive season, and even that festive season spillover is also continued for a couple of weeks. So we are right now. It is quite encouraging.
Okay, that's good to hear. So that double-digit growth would balance it out for the rest of the quarter, is what I'd imagine. So early teens, early double-digit growth can be expected for the quarter as well, you think, for the next quarter?
Yes, yes. See, I'm talking about are talking about fourth quarter?
Also, you know, one question that my analyst has asked me to ask you is that in an era where it's all about quick commerce and e-commerce, you mentioned to me saying that the touch and feel is important when you're going on and buying a television, for example. Are you still very constructive, or are you going back to the drawing room and revisiting your strategy on the erstwhile old school brick mortar model, or are you, building in plans to build out your e-commerce?
Currently, we don't have any plans to build a e-commerce business. Of course, we have been selling on Amazon and Flipkart portals. That will continue, but as such, we don't have any plans to build our own e-commerce portal.
Right, sir. So also very quickly, a quick question on margins. Now, of course, we've talked about everything that impacted your top line, but margins have also been hit quite badly this quarter. What led to that, and was it a one-off, or is this going to be the new sort of normal in terms of margins for the rest of the financial year?
See, if the store throughput reduces, obviously it will have a direct impact on the margins, because we cannot cut down the store operating expenses. So, for example, like whether customers are there or not, we have to run the air conditioners throughout the period when the store is open. Like that, certain things, or rental costs cannot be reduced, and store operating expenses will continue. Except the sales incentives, all other costs are more or less fixed. So that will continue, but it can be easily absorbed when there is a demand in the subsequent quarters.
Interesting. Yes, it's a lot of it is fixed cost. But thank you very much, and good luck with business. It's good to hear that early signs are quite promising, at least with regard to festivities and wedding season. With that, we're completely out of time. The Nifty is still struggling, but we're holding on to 23,700 for now. With that, we wrap this edition of the Small and Mid Cap Show, but there's a lot more programming on the channel, so stay with us.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro,
What are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew and with me is Puneet Javeri. Puneet, good morning and good morning to everybody tuning in. We'll take you through the next the next 1 hour of trade. Let's take a look at where the markets are right now. And we've got the Nifty 50 with cuts of about 0.75% right now. And it's a tough day for the equity markets. It continues to be tough to trade in the equity markets right now. Let's take a look at the broader markets as well. And that's where quite a bit of pain has been, and you have the mid-cap index very close to the low point of the day, down about 1.9%, and the small-cap index losing even more, down about 2.4%, also at the low point of the day. And just like the end of yesterday's session, where you saw a considerable number of losers for every gainer, that continues to be the case today as well. If you look at the market breadth, it will be tilted very, very sharply in favor of the declines right now. In fact, it is even worse than it was in trade yesterday. India VIX has been elevated. It continues to be elevated. It's up as much as 4% in trade today. But take a look at the sectoral performers as well. And you have most sectors in the red. In fact, all sectors at this juncture in the red, led by the realty index, which is losing about 2.3% right now. You also have metal that's down about 2% or so. Auto down about 2% or so. And while it's been tough for all of the incumbents, the new joiners or the new entrants to the equity market have not necessarily had it easy either. It's been a pretty volatile day and baptism by fire for a couple of these companies. Acme, for one, had a little bit of a wobbly listing. And you also had, there you go. So it's off the low point of the day, but it's still down about 6.3%. Swiggy, for a little while, came very close to that issue price, but it's now about 13.5% higher. So it's finding buyers, and it's up about 13% as we speak right now. But speaking of new listings, there is one that's under pressure, Puneet, and that's in the automotive space. Hyundai Motor India, down about 4.65%, and it's lower than the issue price. Why do you think that is?
I think one of the major triggers was the Q2 results which came out yesterday. So they were expected to be subdued because they had lower volumes in this particular quarter. But it has been, a subdued performance by the company. They had roughly 8% of fall in terms of volumes in Q2. And brokerages have also come out with, mixed views for the company. Now, if we talk about, the positive one, the Nomura is the first one. They have a target price of about 2,472 rupees per share. It's a huge upside from the previous close. It's a 37% upside. And for them, one of the key parts has been that it's a very attractive risk reward in terms of valuation for the company from this point on. they have also said that new capacity in the Pune plant, which they have acquired from General Motors, will add roughly about 1 million capacity or in the next 2 to 3 years. That will also aid well for the launches as well for the company. They're also expected to have roughly 7 to 8 models which will be coming in over the next 5 to 6 years that will drive strong growth. And as I mentioned, it's trading roughly at about 18 times price to earnings for FY27, and for Nomura specifically, that's one of the key points. When you look at the second one, that's MK, they are slightly negative on it. Target price of about 1,750 rupees per share. And the fact has been that, they see the soft quarter has been one of the key things, and they prefer someone like a Maruti Suzuki over Hyundai in terms of valuation and financial metrics as well.
Okay, so all right, so that's the perspective from the brokers, but let's find out what our experts have to say. Saurabh Jain of SMC Global Securities is joining in on the fundamentals. We've got Akshay P. Bhagwat of JM Financial on the technicals. Thanks so much, gentlemen, for taking the time. Saurabh, I'll come to you first. What was the view on Hyundai at the start, and would you say that now that it's down about 12% from the issue price, that it's finally looking a little bit attractive? What's the advice that you would give?
Good morning, Alex. Thank you for having me on the show. See, overall, if you look at the automobile industry, they are struggling with the sales. Earlier, the estimates that were that in FY25, the industry per se would see a growth of 4 to 5%. But with the first half coming in, the growth was, I think, negative to the tune of 0.5%. And if we go by, if we say, judge that the second half probably will see good growth because of the festive demand and the wedding season approaching, maybe we will be able to see 5% kind of a growth. That means sub 5% growth for the industry per se. So it is not that the Hyundai, which is the problem, it is the industry which is struggling with the sales. There is a weak buyer interest. Particularly the one segment which is doing good is the SUV. For example, in the second quarter result of the Hyundai, we saw that the SUV did well, then the hatchbacks or sedans. So the valuation comfort is there, but I think the demand pressure is going to be there for some more time. So in that sense, I would avoid rather the all four-wheeler stocks or automobile stocks for that matter.
Okay, so all right, thanks for that view. Avoid is a call from Saurabh. Saurabh and Akshay, there's an interesting question right at the start. And the first question that has come through, I'll take that in just a bit. Just a quick point to everybody who's joining in for the first time. That number that you see on your screen is where you send your questions to us. And tell us your name as well as where you're tuning in from. The first question, gentlemen, is from Chandan Jain, who's writing in from Hubli in Karnataka. And he's got a very attractive price on Reliance Industries. So I want to actually take this question to both of y'all. He's bought... So the price that he has is 750, and this is obviously showing the ex-bonus price. He's making quite a bit of gains, and the question, Saurabh, is slightly more detailed than just should you hold or should you book profits. Because if you talk about Asian Paints, which has lost a lot of ground, you talk about Reliance Industries, that's down quite considerably. The question is, if you've had patience with a few very big frontline stocks, and if they have underperformed severely, then should you book out? Should you book your profits or book your losses, whichever, whatever have you, and move on? Saurabh, first to you, and then I'll come to you, Akshay, on Reliance specifically.
In my opinion, Alex, we saw a company like Reliance Industry actually see some periods where it did not show growth. Probably the investor must have bought it 4 or 5 years ago. That is why his price is 750. In my opinion, I think the first thing which probably the investors were looking for the demerger announcement, which did not came in the annual general meeting, and now the one of the subsidiaries coming out with the IPO. That means the existing shareholder will not be rewarded because for the demerger they were expecting. And I think this was one of the disappointment. Second, I think overhang is maybe the Elon Starlink may venture into the Indian market and may disrupt the pricing. So this one is the another risk for the Reliance Industry. And the third one is that I think if you talk about the overall pricing, Reliance pricing and the market pricing, they were on the higher side and were due for some kind of a correction. Now, since the investor is holding for the last 4 or 5 years, I think he may not be in a hurry. So, in my opinion, company like Reliance Industry should be a part of your core portfolio and should be held for the long term. Because yes, many of the verticals which are yet to grow, and the company have large expansion plans in different verticals. So, in that sense, if you are not in a hurry, then there is no need to sell. Be invested, stay put for long term.
Stay put for long term. Akshay, quick view on the charts. Does the chart also indicate a hold, and would you add more?
Yeah. First of all, good morning, Alex. Reliance trend is still strong. If I look at the monthly charts, still we are trading above the major trend line support. The support somewhere works around 1200 as it has corrected in the last 3 to 4 months from the levels of 1550. So my view would be to continue to hold. In fact, if you're open to averaging the stock, 1200, 1225 is a good level to kind of average it, because there is a very good probability that you're getting the stock as cheap as 1200 in last 3 to 4 months price action. So the view is continue to hold. If you want a trailing stop loss approach, 1150 is the trailing stop where you can protect your profits to a significant extent in case the market fall aggravates from you.
Thanks for the view, Akshay. Let me get into the next stock as well. We have a query from Maz here who's writing to us from Mumbai. The stock that he wants to ask about is GMDC. He's bought it at a price of about 353 rupees per share. Average quantity of about 150 shares. The viewer, of course, want to know that what is the current outlook on the company. Let me get in Saurabh first to get his view on the stock.
See, currently what is happening all over the place, I mean, in the global arena, there has been some kind of a pressure on all the commodity pricing, be it iron ore, aluminium, or everything, copper, everything is there in the feeling the pressure. And that is why we are seeing some kind of a selling pressure in all of the commodities. See, if it's kind of a cyclical in nature. If some more stimulus come from the China, then there again expectation will rise that the things will become will take a foothold, and there will be demand going forward. So in that sense, I think if you are there for the long term, stay put, and if you have parked money for the short term, then it is better to exit.
Okay, all right. So conditional advice being provided by Saurabh there. Abhishek has got the next question also from Mumbai. He's asking about Gala Precision. And the stock is under pressure today. Gala Precision Engineering down about 4.2% as we speak, or 4.5% as we speak. But his buy price is below the current market price. 900 is where he bought it at. So Akshay, on the charts, would you continue to hold, and what are the levels that you would watch?
Yes, definitely the approach is to hold. If you look at the price chart, I think it's still continuing in a very strong uptrend. It's just that the last 3 to 4 trading sessions, especially today's trading session, has seen a kind of a price cut of 4.5%. But that really does not deteriorate the trend from a long to medium term perspective. 1000 is a very strong support, and I think the stock should see some recovery back again once it gets near 1100 to 1125 odd levels. So continue to hold. My sense is 1100, 1125 is where you can anticipate a rebound again in the stock. And considering the strong uptrend, right now the price projection can be around 1500 to 1550 from a 6-month plus holding perspective.
Okay, thanks for the view, Akshay. Let me get another technical query that we are getting from Karthikeyan from Kerala. Now, he wants to understand a view on charts on Blue Star specifically. I wanted to ask Akshay to get into this conversation and tell us your view over the next 2 years is what the query is. Akshay, what is your view currently on Blue Star over the medium term, next 2 years in terms of on charts currently?
Well, see, the stock has seen some bit of corrective action right from 2100, and looking at the current price structure, I believe some more pain might be left from the short to medium term perspective. The probability is that the stock can see a downside till around 1600 from the current market price. So maybe still more 150 to 200 points on the downside. But considering from a longer term perspective, I think there is no major trend change. The stock should rebound sharply once this levels of 1600 are tested. So if you're open to averaging, consider buying it around 1600 again. If you have an open position, your stop loss should be around 1500. But longer term, this price story is still intact. It's just the short term pain which you need to go through, and things should normalize back again.
That I would hazard a guess to say that there are quite a few stocks that are in a similar boat right now. Ramki Infra is the next counter that we're talking about. As Satya has got a question on this. He's losing about 22% or so is what he says. He's bought at a 730 price or thereabouts, so that's more or less correct. In fact, if anything, he's lost more than that. 562 is the current market price. It's a fundamental question because this is part of his long-term portfolio, but I'm not sure, Saurabh, if you have a view. Market capitalization of about 3,900 crore. Would you hold on to this or switch out into something else?
I think all things hinge upon what kind of a government capex will be in the second half. In the first half, we saw that the capex was lower, and since the company is largely working in the Andhra Pradesh, so I think the expectations are quite a lot. So I think it is better to hold, see how second half goes, and then take a call. Maybe I think things will improve, and so the stock price.
Thanks for the view, Saurabh. The next query we are getting is from Vishnu, currently giving us query from Chennai. He has 30 shares in this particular stock at 548. IRFC shares is the other one. They have 80 shares currently coming in. So REC is the first query that he wants to ask on. He's bought at 548 rupees per share. 30 is the quantity. Let me get an Akshay for a view on the same. Akshay?
The last 5 weeks have been in a range for REC Limited, and somewhere there is some consensus buying happening from the short-term price chart around the levels of 490 to 500. So that is defining your short-term price support zone. But if I look at the broader charts, considering the broader market conditions, there is scope that the supports may get breached, and you might see 450 on the lower end. So this 450 target is only from short to medium-term perspective, time horizon 1 to 1.5 month. But if you're open to holding this from long-term, really there is no major sell signal or destruction on the price chart from a longer term perspective. Should be open for averaging around 460, 65 whenever the opportunity presents you. I think longer term still the price structure is intact for targets of 650 plus.
All right. Just like yesterday, today we have a few viewers who have been holding on to stocks from IPO, and that's an encouraging trend to say the very least. Balwant has been holding Tarshan's products from the IPO price of 662. Let's pull up the chart and see where it's currently trading. And he's got 22 shares that he has bought, 400. So he's had patience despite the fall in the stock price. Saurabh, what should the view be? Should he hold and have patience and anticipate growth in the stock, or should he switch out into something else?
Maybe you need to take technical help. I will not be able to give you.
Okay, fine. All right. Do you have enough data on this one, Akshay?
Yes, I do have, but looking at the price structure, it is trading negative, and the expectation is that the recent support zone where it is nearing is around 385. That also eventually should be broken, and we might head lower till levels of 300. So I would suggest better take an exit. If not taking an exit, you want a revised stop loss approach, then at least maintain a strict stop loss of 375. But the view clearly is to take an exit, if not below support, then at least on a slight rise around 450, 460 if the opportunity presents you. But keep a trailing stop loss. That's a must because the broader trend is weak, and possibly my sense is 300, 320 is where the stock should be heading for.
Got that view, Akshay. Now, we have another query coming in from Hema now on Sterling and Wilson. Now, the price that she's bought in it is 668 rupees per share and has a quantity of about 200. Now, stock has done really well, about 72% returns in this particular year, but it's still away from the price that she's bought in at. Let me, get in Saurabh for a view on this. Saurabh, any kind of qualitative view that you have on Sterling and Wilson?
See, while the company is good and a lot of growth opportunities lies ahead, but at the same time, valuations were very high. And in my opinion, I think these are the valuations which have subsided, and maybe some more is in the offing. So if you have a long-term view, for example, for that matter, for maybe 3 to 4 years, then it is okay to hold.
Harsh from Indore is asking a question on Tata Motors from the automotive space. I know. I kind of know what Saurabh has already said, but I'm going to ask him to reiterate. Saurabh, you said that you would be avoiding automotive companies for now, but would that be the case even for the long term? Would you use any opportunities, any dips to buy into Tata Motors?
I think if you look at the Tata Motors domestic sales, they were quite okay. The company was quite confident. But at the same time, you see the industry is not likely to see growth of more than 3 to 4%. And in case of Tata Motor, sales problems lies with the even Land Rover and Jaguar in Europe and China. Because if you see European market, it is not showing any kind of good demand. In China also there is good amount of pressure. So in my opinion, I think it is better to avoid.
Okay, I just want to point out, Hema is pointing out that she's not from Rajkot, she's from Abu Dhabi. Take the next question.
Yeah, sure. Next question, it's coming from Naresh now. Now he's holding a very recent listing as well, Bajaj Housing Finance. A small quantity of 10 shares, but at 134 rupees per share. Let me get in a fundamental view first from Saurabh, because valuations are pricey for the quality of book of Bajaj Housing Finance, roughly about 1 lakh crores of AUM. Saurabh, what's your view on Bajaj Housing Finance currently and the outlook for the same?
See, the company has always grown ahead of the industry. I mean, they have always posted good growth above the industry average, and the management is quite strong in their business domain also, and the space is also quite good. So valuations, as you have already said, that the valuation is looking a bit on the higher side, but from the long-term perspective, I think it is a good stock to hold.
Okay, good stock to hold, Bajaj Housing valuation. Speaking of high valuations, this is a stock that we've spoken about at length, so I'm not going to talk about the valuations of Suzlon. I'm going to talk about the technical levels that you should watch out for. Himanshu has not mentioned, Akshay, that he's bought the stock. I guess he's kept it on his radar because he's looking for opportunities. And man, it's under quite a bit of pressure today. Would you say that that opportunity has been found, or would you say it's not good to catch a falling knife?
Right. Really, it's not a good time to catch a falling knife because we are in a market where, mid caps, small caps, supports are being easily breached. So you need some kind of stability, some kind of a pre-move in terms of a bounce back being shown by stocks that would give you some kind of confidence that indeed there is buying demand. So instead of preempting the supports and going for preempting the dips in the market, it is better. You might miss out the early 2-3% move, but rather be on the safer side. So here, Suzlon probably is heading for levels of 50 or 47. That's the support at least which is coming out right now. So let the supports be tested. There we need to take a review again whether we need to buy or not. In case you're holding, I would suggest at the current market price, it is better to take an exit if you're a short-term trader.
Exit in the short term, if you're a short-term trader, that's the view coming in from Akshay. The next stock we have on radar is Aditya Birla Capital. Now we're getting a query on the same from Sumit from Mumbai. He holds about 500 shares of the company at 216 rupees per share. Now it is currently lower from that particular price. Year to date as well, it's been around, just given about 13% returns. Let me get in Saurabh for a quick view on the same. Saurabh, what do you think about AB Capital? Any kind of qualitative view that you might have on the same?
See, in my opinion, I think the stock has been a laggard if you compare with the other stocks in the same domain. And I think when the markets are, there is kind of a bearishness in the market. Companies like AB Capital see pressure coming in. So I think it is better to avoid for that for some time.
All right. That's a view on AB Capital. Avoid. Any recommendations on PSU stocks? This is a question from Karthik. He's writing in from Chennai. And so he's wondering whether to buy for the long term. There are several that have cracked a little bit. Saurabh, anything on your radar that you've been looking at based on the fundamentals and valuations that stand out?
I think utilities and bankings are looking good to me. In the utility space, I think Satluj Jal Vikas Nigam kind of a stocks, on the hydropower side, and which have, the company has a lot of expansion plans also. In the banking space, I think companies like Bank of Baroda, for that matter, and SBI also have posted good set of numbers and are expected to post good set of numbers too. The valuations are converting. So he can choose from these banks.
Got that view, Saurabh. Now, the next stock that we're looking at is Deepak Fertilizers. Now, we are getting, this query from Naman from Kolkata. He holds about 60 shares of the company at roughly about 1,385 rupees per share. He's looking for a trading view over the next 30 to 45 days. So let me get an Akshay for, a recommendation on for a view of his stock because it's done very well in this particular year, about 80%. Akshay, what do you think of Deepak Fertilizers?
Yes, it's done well, but considering the market conditions and the overbought nature of the stock, we did have seen some profit booking from 1400 levels. Consider this as a good opportunity to re-enter the stock because the trend is pretty strong. I think levels of 1550, 1170, roughly the 20 odd point range is where the stock should take support again. So if you are keen from a short term view, 20-25 days holding, that's the level where you need to take a buy entry in the stock. Your stop loss should be below 1100 and any recovery should see the stock again getting past the recent swing high of 1400. So 1400 is your first target and 1475 can be your second target.
Under pressure, another stock that's under pressure today, 4.5%. Shama Azhar from Uttarakhand is joining in. She's asking about a frontline banking stock, HDFC Bank, which she has bought at levels of 1,714. The question is it safe to hold HDFC Bank? And Saurabh, I'm going to ask you this question without adding any qualitative lines to this. Is it safe to hold HDFC Bank? What would you say?
I mean, it is always safe to hold HDFC Bank. There is no worry. It's not any small bank. The point is, after the merger with the HDFC, there has been some problem. The integration is going on, and after a few quarters, I think the banks will come back to the growth. I think 14-15% kind of a growth you can easily see in the case of HDFC Bank. You should have it in your long-term portfolio, and it's a hold.
Follow up on that, are you anticipating that there will be an upside based on global inflows? The MSCI rejig comes into play, I believe, on the 25th of November. I'm not remembering the date right, maybe. But do you anticipate that that will aid the stock?
I can't say particularly for the HDFC Bank, but I think in the banking space, surely there will be some flows coming in because I think it is the sector which has shown quite a lot of strength in the recent meltdown of the markets.
Got that view, Saurabh. Now, let me go into Tata Steel. Now, we are getting a query from Sneha from Hyderabad. She holds about, the shares of Tata Steel about 150 rupees per share. Let me get an Akshay for a quick view on the same. It's been very active, the metal space, because of China, because of the US elections as well. Any kind of view that you have on Tata Steel, Akshay?
See, in the metal space, 1.5 months back, we did see a lot of price momentum, but unfortunately, Tata Steel has not lived up to that kind of momentum which the other stocks in the sectors did see. And even if you look at the current setup, the last 3 months support zone of 145, 150 has been broken very significantly with volumes, which is a negative indication from short to medium term. So my sense is stock is heading for probably around 115 to 120. So the suggestion is if you are short to medium term trader or holding the stock, take an exit. Probably it's not the right time to get into as of now.
Okay, all right. Gentlemen, stay with us, Saurabh and Akshay. We'll be back after a very quick break. Viewers, we have a lot of your questions in. And by the way, that number that you see on your screen, you can send more to us. We'll be back on the other side to take more of them. So do stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Traffic 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Welcome back. You're watching Ask Profit. This is the show that gets you answers to all of your stock-related questions, and to that end, we'll get the number on the screen in just a moment. You can send all of your questions to us and we'll take as many of them as possible. I just want to point out that if you've got specific questions on futures and options, you don't send them on this number. We've got a specific show at 10:30, futures and options. It's called FNO. Or what is it called? It's called the FNO show. It's called the FNO show, and you can ask all of your FNO related questions on that show. We'll have that number pulled up on the screen in just a bit. Don't send it here. The first question we're taking is actually a clarification. Saurabh, you said that you would avoid Hyundai, but the question from Purushottaman K is that if you've gotten allotment in the IPO, would you sell it at this point?
I think it depends upon your time horizon. If you are here for the long term, I think if you are betting for the automobile industry for the long term, I think there is no problem in holding Hyundai, and the valuation comfort is also there. See, after the COVID, the industry have seen a stupendous growth. Every year they've seen a double-digit kind of a growth coming in, and this is the first year where we're seeing that the demand is slipping. There has been huge, demand for the SUV. The share which earlier used to be 15% kind of a share, now gone to the 60%. So after the huge base, it is quite obvious that the industry will see subpar growth this year. I mean, sometime in any of the year, and this is the year which is being witnessed as the one. So, if you are here for the short term, I think it is better to let it go, better to exit. But if you are here for the long term, I think stick with it.
All right, stick with it is the view. I've got a question on Dabur, and this is from Mahima. She's asking, would you hold? This is now bought at levels of 580, 100 shares, and so she's losing quite a bit of ground right now. Would you hold based on the fundamentals? Let's very quickly take a fundamental view, and then Akshay, I'll come to you on the technicals as well. Saurabh, what's the view?
See, consumer companies are facing difficulty with the demands, and also in some cases the raw material prices are also going up. Dabur has a portfolio which works well especially in the winter season. So I think it is a good company. It is a great franchise. I mean, it is. I mean, they have very good product portfolio. It is because of the lower demand that we saw some kind of a pressure coming in the stock. I think wait for next 6 months. Surely you'll get your price.
Okay. Surely you will get your price. All right. So that's the view on the fundamentals. But Akshay, what would you say on the technicals? At any point, would you say that you can deploy if you have the ability to?
Dabur unfortunately is mostly heading lower end at 488, 485 zone. That's around 20-25 rupees, still further downside. And then we are looking at a very crucial support. And the question is whether the support holds or not. In case it breaks, we are heading for a downside till possibly 400. So the major key point which you have to note from a technical standpoint is how it behaves once it tests 485 level. So my sense is keep a strict stop loss of 480 on this stock. Any rebound, maybe it happens this month or next month and doesn't break 480, you get a rebound till 550, 570, use it as an exit because I don't see any major recovery happening in this stock in the next 5 to 6 months.
Got that view, Akshay. Now, the next stock we have is, a retail investor favorite, Vodafone Idea. Now, we are getting this query from S. Raghavan. Now, he holds about 1,140 shares of the company at roughly about 8.45 rupees per share. Akshay, do you have any view currently on Vodafone?
I think from the telecom space, Vodafone attracts a lot of retailers considering the price of the stock per share, and also the kind of momentum which we had a few months back, right from 6, this stock almost tested 18. And I believe many of positions have got stuck at higher levels of 16 and 18 and really looking for an exit. But the price structure is really negative. The chances of this stock heading to the lower end support zone of 5.5 to 6 look higher. And that too doesn't mean that from the supports it will show a strong rebound. There is no news or no positive price trigger to in this stock, so I would recommend to take an exit. Better be invested in other telecom stocks. Bharti Airtel is a good name to look forward to, but for Idea it's clearly an exit for me.
An exit, all right, and it's seen price erosion that has been quite considerable from the double-digit mark back to penny stock levels. Let's talk about Asian Paints next, and we've got a viewer, Adarsh, who's bought at levels of 2,548. And for so long, Saurabh, this is a stock that had to be part of the portfolio. It was synonymous with quality, but unfortunately, it has disappointed investors across the board, especially those that have retained patience with the stock and held for 5 years. They've got nothing to show for it. So would you say that you would exit at this point if you've held for some time?
I mean, surely, if it behaved like maybe for the matter Hindustan Unilever, it also did not give return for the last 4 or 5 years. And this time around, Asian Paint is seriously struggling with the sales, the raw material cost and all, the margin pressure and the price erosion which they have seen. The demand is languishing in the premium segment, in the decorative segment. Segments are not doing well, and in my opinion, I think it is better to exit. In the same industry, the one stock which has did well maybe is the ExxonMobil. So if you wants to switch, you can switch your money.
Got that view, Saurabh. Now, the next query that we have is on Easy Trip Planners. Now, we are getting this query from Swami from Bangalore. He's asking his view if he can get into this particular stock currently. Now it's been in the news. It is a travel and ticketing company, but now they are also venturing into manufacturing of electric buses. That's a first. The stock also hasn't done very well on a year-to-date basis, about 26% down.
And there was promoter selling as well, which
huge promoter selling
down,
in this particular year as well. Let me get in both of your views on the stock first. Let me go to Akshay first on a technical side. What is he seeing on Easy Trip, and I'll come to Saurabh then after.
Well, for Easy Trip, I think the price structure is negative. So I would suggest the way the price has seen a hammering from the top levels this year, 25% plus depreciation in prices has already been done and still more to go. And I do not see any short-term support yet in the making. So at least on the technical side, I would recommend to take an exit in the stock.
And what about you, Saurabh? Any kind of fundamental view that you might have on Easy Trip?
I think venturing into new vertical, which is difficult for the even for the existing player, and they have yet to prove their capabilities, may not reap much results for the company. I mean, that is not expected from a company from the travel and tourism space, a company from the travel and tourism space. So in my opinion, I think it is better to avoid.
Better to avoid this is the view. We've got IREDA that is being asked about by Manoj. He's asking whether it can be accumulated at this point for the long term. 221 is his buy price, but he's wondering whether it can be bought at even these levels. And he's looking at the next 5 to 6 years. So I guess he can wait, Akshay, to deploy. What would you say are the good levels to buy at?
See, from a long-term perspective, for me, the data is a bit limited because I believe you have around 8-10 months of data. But whatever data piece I have in front of me, I think this stock has still some more room on the downside. Probably 150, 160 would be more attractive levels for averaging or buying in the stock. The sense is long-term should be good. The way it has opened post the IPO, the initial reaction has been. So consider buying it, but wait for slight dips, 150, 160, although pretty far off from where we are. That's the appropriate level. I would be more keen on buying. And I think the broader trend should be on the upside once that dip is seen.
Okay. All right. Geo is the next counter that we're talking about. JFS, Geo Financial Services. Can it be bought at levels of the current level, 302 or thereabouts? For the medium term, Bharat Marfatia is looking to buy 1,000 shares. I'll come back to you, Akshay, on the charts. Would you suggest that that's a good price? It's one of the few stocks that is gaining in trade today.
Yes. So Geo Finance, I think, as I see right now, there is some negative breakdown which I see on the charts. It is breaking the key support zone of 310, 2% down. That's slightly negative setup. So short term, there might be some pain, but really from a medium to longer term perspective, this stock is the right stock to be invested in. Technically, it has a price strong structure. Some value buying is evident in the prior history around the levels of 275, 290. So these are good lucrative levels to start accumulating the stock. So consider buying it. Do a staggered buying in the range of 275 to 260, and eventually from a longer term perspective, the price structure bodes well for targets of 400 plus in Geo Finance.
Okay. 400 plus is the target that you can look at. Kutan from Puducherry is asking about Bank of Maharashtra, and we've got Saurabh who's already spoken about the banking space and given his view. But specifically on this, if you bought at levels of 55.8, which is not too far away from the current market price, and you've bought 1,577 quantity, would you hold on based on the fundamentals, Saurabh?
Surely, I mean, the results were good. I mean, the bank has shown above industry average growth. The balance sheet is also neat and clean. I mean, the NPA levels are quite comforting. So if you have long-term perspective, I think you must hold on to this stock.
As I understand it, I believe that we have a live interaction that is taking place with the management of Swiggy, and this is an exclusive chat. The stock is up quite significantly at this point, at the high point of the day, if I'm not mistaken. Let's go across to the management.
This is a very important milestone for both Swiggy and Prosus. For Prosus, it's a validation of our investment thesis on India. It's a validation of our investment thesis on food delivery. We've made some nice returns on these investments. We are taking some money off the table, but we continue to be the largest shareholders, as you said, Shub.
Although you said that you continue to be the largest shareholder, but you are planning on sharing, selling off some of the share. Is there a reason why?
Not anymore. So we already sold in the IPO, and we don't plan to sell anymore.
No further disinvestment?
No.
So what do you think is, the psyche of the other shareholders in Swiggy currently? Is everybody happy?
Oh, I'm sure people are very excited. It's been a long journey. Harsha has been an amazing founder. And some of us have been on the cap table for a very long time. And I can see that excitement, general excitement amongst the shareholders for sure.
All right. That was a chat with the investors at Swiggy, so quite enthused with the listing gains that they are witnessing, and they're not looking to sell anytime soon. Let's talk about what we do now, and in fact, we're going to be taking up the rapid fire segment. This is where I toss as many questions at Akshay and, of course, at Saurabh over the course of the next 2 minutes. Please, gentlemen, answer as quickly as you possibly can. The first one is on Asian Paints. Which blue chip company would you buy for the long term right now, Saurabh?
Larsen & Toubro.
Larsen & Toubro. Worry Energies, would you buy into this right now? I'm coming back to you, Saurabh. Rajan Raju wants to know.
Buy in a staggered manner.
Okay. State Bank of India, would you buy today, or would you wait for further drop in the stock, and what target would you put on it? I'll come to you, Akshay.
I'll wait for a dip, probably around 780, 785 is my entry zone for State Bank of India.
Okay, hopefully, Divya, that answers your question. RVNL, this is a question from Subodh Malhotra, who's asking about this. He's bought 200 shares at a price of 300, if I'm not mistaken. Yeah, all right. So he's wondering whether to enter the stock at this price or not. Akshay, what's the view on the charts, RVNL?
Avoid, try entering around 350, 370 zone.
Okay, Dhanlakshmi Bank is a counter that we're talking about. Grismi from Cochin is asking about this. 45.75 is the buy price. Would you hold on, Saurabh, on the fundamentals?
Exit by Bank of Maharashtra.
Okay. Raj from Bengaluru is asking about a couple of counters, in fact, several counters, but I'm going to stick to one. Bharat Dynamics, in which he's got a 30% loss. Would you suggest holding on or switching to something else, Akshay?
I would recommend to exit Bharat Dynamics.
All right. The next question is on Natco Pharma. Vignesh from Bengaluru's bought 150 shares at a price of 1,455, which is not too far away from the current market price. Saurabh, on the fundamentals, would you hold or sell?
Hold for long term.
Okay. Is this a good time to play the Nifty or the Nifty Bank? Akshay, do you want to weigh in on this? Would you stay away from it?
I would stay away. I would wait for levels of 23,400 to 500 zone to take a punt on the buy side.
Okay, one last quick question as a bonus. Since it's Swiggy listing day, Saurabh, would you buy Zomato today?
I will avoid.
You would avoid, all right. Thanks so much, gentlemen, for taking the time. Saurabh and Akshay, always a pleasure having you on the show, and thanks so much for answering all the questions that you did answer today. So it's been an interesting session, and in fact, let's talk about earnings. And I believe we have a management joining in right now.
Yes, definitely. Jai Balaji, is the next stock that we are tracking and is focused in right now. The stock is under pressure on the back of its Q2 results. The profit also dipped about 24%, while revenue was flat. To discuss more, we are joined by Mr. Aditya Jajodia, the chairman and the MD of Jai Balaji. Mr. Aditya, thank you so much for joining us today, and talking to us about your Q2 results. I just wanted to start with, realizations first, because we have seen flat revenue growth in this particular quarter. Talk to us mainly what led to this lower realization, and going into Q3 and Q4, any kind of outlook that you have on the realization target.
Firstly, a very good afternoon to you and to all the viewers. Talking on the realizations, since it is normally normally in the second quarter, it is the post-monsoon quarter, and also it was the post-election time. So slightly the realizations were slightly lower by around 3 to 4%. And as far as the volumes are concerned, the volumes were more or less matching if you compare to the last quarters also.
Okay, talk to us about pricing as well. You have been able to maintain your margins, particularly in the value-added products category. Is there any pressure that you're seeing on the pricing, and how are you dealing with that?
See, before we come to the pricing, one thing should be highlighted is that if you compare our results to the first quarter, means the second quarter, normally for all the companies of our product lines, they are normally slightly muted when compared to the first quarter. But if you compare the results of the half yearly of the last year, there has been a revenue growth of approximately 10%, and the EBITDA has grown by approximately 29% if you compare the growth as compared to the last year. So, in fact, I will be very happy with this performance, because in spite of this muted second quarter, the half-yearly targets are on track. And,
essentially saying, Aditya, is that the second quarter is usually a weak quarter. Is that right?
Yeah. Normally it is this way with all the companies like us.
Okay. So, but specifically, I would assume that's because of a lull. But would you say that there is pricing pressure as we speak right now, even in the third quarter? And what are the trends there?
See, there is a steady bit of pricing pressure, at least in the commodity sector, because in the commodities, China has been dumping a lot of steel into India. So there has been a little bit of softening, and also due to the geopolitical reasons. But as far as our value-added products are concerned, which is approximately 50-55% of the product basket, there has been some pricing pressure, but by and large, it is not much. as well compared to the commodities.
Now, Aditya, I just had a question now on your margins because it has been stable and grown actually while revenue has been flat. Now, value-added products has been something that's supported the margins. And please correct me if I'm wrong. What's the current percentage of value-added products in terms of your total sales, and how do you expect that going into for ending FY25 as well as FY26 as well?
See, in case you recollect, as we spoke last time, means the last quarter, we are already undergoing a Capex plan of around 1,000 crores entirely with the internal accruals. And after the completion of this Capex of 1,000 crores, which will be completed over the next 6 to 8 months, currently our share of value-added products in the entire product portfolio, it is around 55%. This will be going up to around 80 to 85%. So in the next financial year, it should reach around 70-75%, and post that, once the entire benefit of the entire Capex kicks in, it will be around 80 to 85%. So our strategy has been very, very clear, is that we want to be a low-cost player in all the categories of all the products, and we also want to add maximum possible value to all the products so that the margins are protected.
Okay. Okay. Can you help me understand the scale-up over the course of the second half of this year, though? You're saying that by next financial year, and I'm interpreting that, Aditya, as fourth quarter of the next financial year, where you would be 75% value-added products in revenue. Is that the correct interpretation, or would you say that it would be right from the start of next financial year?
What I would like to say is that this particular Capex program, it is happening in modules.
Okay.
For example, our ductile iron pipe capacity, which was 2.5 lakh tons last year, it is right now around 3 lakh tons. By the end of the third quarter, it will be around 5 to 5.5 lakh tons. So you will be seeing incremental volumes from every quarter year on. So when we are talking about 80-85%, it will be by the end of next year, we'll be reaching that in the fourth quarter.
Can you help me understand what the current capacity utilization is? I understand that more will come on stream, but in currently what you're operating, what is the utilization?
Capacity utilization for the plant as an aggregate will be in the region of around 80%.
Okay. Okay. So, and then what is the implication then, Aditya? You've mentioned that the scale-up will happen and the move towards a higher share of value-added products. You've already seen a 92 basis point or close to 1 percentage point improvement in the EBITDA margin for the second quarter. What is the kind of profile that will take place once you make that sizable shift? Are you moving higher?
Yeah. See, our guidance to our investors in the I was saying in all the investor con calls is that our target will be to be in a region of a EBITDA margin of around 18 to 20%.
20%.
Currently, we are at 15%, and we are expecting to move to 18 to 20%.
Okay, that is for this. So, but as I understand it, the guidance that you provided for FY25 is 17 to 18%. So you're saying next year you will get to 18 to 20%.
Yeah, absolutely.
Understood. Puneet?
No, just wanted to understand about, the ferroalloys capacity as well. Now, it has been, it is expected to grow. How are you seeing the current market for ferroalloys currently?
See, the current market for ferroalloys, it is also slightly muted because ferroalloy, if you talk about the generic ferroalloys is a pure commodity play. But when we are talking about our ferroalloys, we are talking about basically very specialized ferroalloys and for niche products. So our niche in this particular segment would be is that since we are making the specialized ferroalloys, which we are currently exporting to around 40 countries, so we will be trying to create a niche market which is already there for us right now. So our margin will be slightly better as when compared to the generic ferroalloy players.
What's the current competitive intensity in this particular market of ferroalloys? Because you are mentioning that you export to roughly about 40 countries, as you mentioned. How are you seeing the competitive intensity currently for the same?
See, competitive intensity in this particular segment, because the segment is very, very specialized, here the competitive intensity, it is not as much. Means in India, in fact, we are one of the only producers right now making these ferroalloy products on an organized basis. But if you take it internationally, there are some established international players, but their cost of production, it is not very cheap when compared to our costs. And also, but this is a very difficult market to penetrate. So the competition intensity arises not only out of the technological barriers, it also arises out of the marketing, I will say, difficulties associated with these products.
Last question then, Aditya. Leave us with an outlook on volumes, because given what we know and given everything that is happening, you also mentioned China dumping is a bit of an issue. leave us with an expectation of how you think volumes will play out in the second half. You've certainly said that Q2 is weak. Do we anticipate that Q3 and Q4 will be significantly better than the first half?
Firstly, I would have to clarify that when I mentioned about China dumping, means I was very specific that China dumping is affecting the commodity. It will be affecting the prices of the commodities, like flat products, long products, TMT bars, sponge iron, pig iron, etc. But these prices, but this dumping of China does not affect the specialized products by and large on a day-to-day basis. Number one. Number two, as far as the volume is concerned, as the Capex are actually now rolling in, and as the plants are being commissioned, so in every quarter we will be seeing substantial volume growth.
Fine. All right.
Thanks so much, Aditya, for joining us and giving us a view on your Q2 earnings. We wish you the best and look forward to our next conversation. But thank you so much for joining us today.
Thank you so much. Thank you.
Well, Alex, I just wanted to highlight a couple of stocks because the auto sector is really in the doldrums today, and a couple of them. Just the first one is Suprajit Engineering. I just want to talk about it. It's seen a very sharp reaction to its earnings yesterday. We did speak to the management while it's down about 9.2% right now. So that is a concern. Now, yesterday when we spoke to the management, it was that the profits were down roughly about 98% in this particular quarter. And they are going through a number of measures right now. So restructuring has been one of the key things. So it was a miss on EBITDA as well as profits, while they had also higher costs related to one of the recent acquisitions that they've done of SCS in Germany. Now, just for some context for our viewers, this was acquired under liquidation in Europe, and the management has been, they have closed down one of their plants in the country in Poland, while they are also looking at integration of people currently. But that has also led to higher costs, which saw the profits down by about 98% in this particular quarter. What's encouraging is that brokerages, some have cut target prices very sharply. One of them is MK. They have said that they are expecting a target price of about 400. But overall, the management is very, of course, confident of the same. They have mentioned that the turnaround should see some one-time costs that happen in Q2 shouldn't happen in Q3. But currently, the investor sentiment and the stock price is reflecting that, the restructuring costs have been much higher than anticipated. There was an expectation of a profits of about 50 crores in this particular quarter. That's not come in anything close to that. But that was one of the stocks that I just wanted to address. Suprajit Engineering on earnings, definitely now down about 9.7%.
And there are some interesting brokerage notes that have also come through. And we mentioned a couple already, but then one, of course, is that Macquarie has initiated coverage on 4 energy companies. And it's quite an interesting space as well. Power Finance Corporation of India, REC, Power Grid Corporation, and NTPC, all of them with an outperform rating. The stocks are not doing too much at this juncture. They were, in fact, higher. NTPC certainly is. But in an otherwise weak market, you can assume that there is some buying on the back of that. There is likely to be a significant play in the space, and what they're talking about is that the power landscape looks very different than it did 10 years ago. The problems in terms of leverage that certain entities had in the space are no longer what is currently being witnessed, and you have the loan books that are growing in a very healthy manner. There you go. The target and the upside quite significant at that. The upside of as much as 31% for something like a PFC, 25% for something like an REC. All right, and on that note, as we end this program, we have the benchmark that is trading more or less where we started the program at, 0.75% lower. So not too much more in the way of damage being done over the course of the last 1 hour. But that brings us to the end of this particular edition of Ask Profit. And from Puneet and myself and the team that put this show together, thank you so much for watching. Do stay tuned. This is NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money. Hello and welcome to Hot Money. This is Hiral Daria and with me is Mahima joining in. Let's take a look at how markets are panning at this hour. Clearly, if you see in terms of Nifty as well as Bank Nifty, interesting moves coming in. We've slipped below the 23,800 mark already. In fact, 23,700 is what we've broken, 0.8% lower, nearly 200 points is the kind of cuts that we're seeing in terms of Nifty 50. Let's pull up Bank Nifty as well because that's going to be interesting. Bank Nifty and IT were a little bit resilient over the last couple of trading sessions. Today, 0.9% lower in terms of Bank Nifty, and if you see the Nifty IT index, there you go, cuts of 0.6% coming in there. So that's where the entire action is. If we can have the heat map in terms of Nifty 50, that will give you a clear indication of the stocks that are contributing to the kind of cuts that we are seeing in today's day of trade. This is the heat map with regards to the sectors, but all sectors in the red. Nifty Realty 2.8% lower. NTPC, Trent, Britannia are holding up. However, you have a Hindalco 3.5 to 4% lower. Eicher Motors under pressure. Apart from that, M&M, Tata Steel, Bajaj Auto, all of these counters taking a beating, Mahima. Clearly, you know, there is pressure on the large caps. How are the broader markets looking like?
Let's pull up the mid-cap 150 and the small-cap 250 and see what is the kind of pressure that's being seen. Well, both the broader markets, you know, the indexes are under pressure. The mid-cap 150 is down around 1.9%. The small cap 250 is seeing the real pain and is down around 2.2%. In terms of some of the stocks that are, you know, pulling down these broader markets, if you can pull up the NSE 500 stock chart and see what are the stocks that are really seeing the pain and the pressure in trade today. Let's pull up some of those stocks and see. There you go. There's Hitachi Energy down 7%, Suzlon Energy down 7%, PNB Housing seeing a lot of pressure down 5%, Motilal Oswal. After seeing gains for about 2 days now, it's seeing some profit booking down around 5%. Century Textiles also down 5%. But some stocks that are bucking the trend and holding up is KNR Construction on the back of its Q2 earnings up 7.6%, Piramal Pharma up 6%, Suven Pharma also up 3%, MedPlus Health also on the back of Q2 earnings again up around 3%, Manappuram up around 2.8%. So these are some of the counters that are buzzing in trade today. But moving on, BLS International and BLS E-Services has come out with its earnings, Q2 earnings. Good set of numbers for BLS International. Overall, revenue was up 21%. EBITDA was up 89%. Margins have significantly improved from 21% to 33%. And net profit was up 78%. But to discuss as to how the quarter has gone by and how things are shaping up for both BLS International as well as BLS E-Services, we are joined by Shikhar Agrawal, who is the chairman at BLS E-Services and joint managing director at BLS International, who joins us now. Welcome to the show, Mr. Agrawal. To start with, your sense of the quarter, how it has gone by. The numbers look extremely well. Is this something that you had expected, and how are things shaping up overall for FY25?
See, definitely, if you see this quarter, we have grown by 21% in terms of revenue, and our EBITDA has grown by more than 90%. And this growth has obviously come on back of a lot of initiatives that we've been taking in the last few years. Even our EBITDA margins, earlier were 21%, then we expanded to 27%, and this quarter we have delivered a 33% EBITDA margin, return. And even if you see the volume of the visa business, it has grown by almost 40%. So this quarter we processed around 10.1 lakh applications compared to around 7.2 lakh applications in last year. There was an 18% in organic growth, and also from iData acquisition, we did 1.6 lakh application volume. So definitely, a lot of initiatives that we took in the last few years has really paid off, and this quarter has been the highest ever for the company. And going forward, we definitely want to maintain this growth momentum. Even for iData, the numbers are not fully from the whole quarter. Only the acquisition got completed on 10th of July. So only 80 days of revenue have come in. We've also acquired Citizenship Invest in October. So those revenues should also come in. Also in our subsidiary E-Services, we have announced the acquisitions of RD Phyllis Loan Solution that should be completed towards the end of the month. So overall, inorganically also things are looking good, and organically we definitely see a lot of growth potential in multiple tenders that are coming out.
Right. Shikhar, congratulations. And an interesting point that you make is that you want to continue this kind of momentum. Would it be right to say that a revenue number of little over 2,000 odd crores for FY25 and little over 600 crores in terms of profitability is what you are eyeing? Or do you think you will be able to surpass that? And in terms of margins, 33 now becomes a base.
See, if you see our growth trajectory in the last 5 years, we have had a growth of around 75% on CAGR basis year on year. Definitely, we want to achieve more growth, but we want to do things in a sustainable manner. So whatever we have done in the first this quarter, we want to maintain that. The margins that we have achieved at 33%, we want to maintain those margins. At a consolidated level, our acquisitions get consolidated. So going forward, my aim and our company's aim is to maintain the numbers that we've achieved. But definitely, having said that, there are still certain countries where we can transition to self-run model from partner-run models. So those revenue profitability will get added. So definitely, we see good growth coming in the coming years.
Mr. Agrawal, you talked about two new acquisitions, that is Citizenship Invest as well as you said to acquire 57% in Adaphidelis Solutions as well. I want to understand that considering both of these acquisitions, you said that you have a revenue target in your mind, but going forward, how much will these two acquisitions add to your overall top line? And with respect to Adaphidelis Solution, it's into sports management, which is slightly different from what you're already doing. So how do synergies match here?
No, actually, first of all, RD Loan Solutions is a company that did a revenue of around 600 crores and an EBITDA of around 22 crores last year. They are in loan distribution business, and under BLS e-services, where we already have 1 lakh touch points across India, they will add on. We will use our existing network to generate more leads and add to that business. So that will add this much revenue in our subsidiary. And Citizenship Invest, this is a niche player. They did a revenue of around $9.6 million last year and an EBITDA of around $4 million. So that will be get added to our BLS International. But not only that, this company is right now only present in UAE. It's a UAE headquartered company present in 2 countries. With our network of 70 odd countries, we want to expand that. So we see good growth coming in both the companies. All the acquisitions that we are doing are all synergistic acquisitions, that we can value add, reduce the cost or increase the profit.
So staying with the 2 new acquisitions that you're talking about as well, what's the kind of revenue contribution are you seeing, potentially from these 2 at its peak?
See, as I said that Citizenship Invest last year did a revenue of around $9.6 million. So that will get added. We completed the acquisition on October. So this quarter, some numbers should come in from that. RD Loan Solutions did a revenue of more than 500 crores last year. So those revenues should get added as and when the transaction is completed. So that is, but on top of that, organically also, as we have won a lot of new tenders in the last few years, we are in deployment stages in different countries across the world. We have deployed some of them already. So I feel that revenue should go up from that as well. And on top of that, there is a multiple, big opportunity of $1.5 to $2 billion worth of contracts that are coming up for bidding that we have been bidding for. So we feel if we can get certain market share from that, we can maintain the growth momentum of the company in the coming years.
Mr. Agarwal, you're sitting on a net cash of around 900 odd crores. Considering the kind of acquisitions that you've already made in the past, any further acquisitions on cards with the kind of cash that you're sitting on? If not, where will this cash be utilized? And if you're planning any acquisitions going forward, what domain will they be into?
See, this cash that we have as of September end, this is post the payment for iData of around 720 crores that we've already made. So as you know, BLS International is a negative working capital, cash generating company. So definitely we generate good amount of cash every year. We are looking right now, we've already done, if you see last year, 2-3 acquisitions. This year also post iData, we acquired Citizenship Invest, as well as now RD Loan Solutions. So certain money will be utilized in the acquisitions of RD Loan Solutions as well. So post that, we are a dividend paying company. We've been paying dividend from the day we got listed, and we are always looking at benefit of shareholders. So we are looking at multiple options. Dividend payout is one that we've been continuously doing. We want to first consolidate all our acquisitions. We've done a lot of acquisitions, get the maximum benefit out of it. And going forward, definitely we are open to more acquisitions in the related field. With Citizenship Invest, there was a forward integration. We were already doing short-term and visas, but now long-term residency and passports, we have gotten into that. Now, BLS International in the visa space, we are looking at if there are not many players in the visa space globally, but in citizen services, there are multiple players across the world. So definitely, in synergistic spaces where the negative working capital business, volume is high, where we can value add and we see a good growth potential. Those are the kind of companies we will look at in the near future in terms of acquisitions.
All right. Mr. Agarwal, one more thing on the cost side of things, your finance costs have significantly gone up YOY, and depreciation has also gone up significantly YOY. I want to understand as to why has this happened, first of all, and where do you expect these levels to be at going forward?
See, some of the countries that we have taken over, so definitely that had led to an increase in cost because cost of services have gone down, but employee benefit expenses and other expenses have gone up. But in terms of finance cost, we had to take a little bit of loan for the acquisition of iData, from tax purposes. So that is why a little bit finance cost has gone up, but that is only in the short term, so that is where we are at.
Right. Mr. Agarwal, one more thing, your digital business has seen, a degrowth in this particular quarter. So first of all, I want to understand why has that happened. And secondly, in terms of iData, what are the targets that you have with respect to this acquisition?
Okay. So first of all, if I talk about iData, this quarter we did around 60 crores of revenue and 23 crores of EBITDA from iData, and that too, the full quarter was not accounted for. As you know, this is also a seasonal quarter for iData. So definitely, we've done 1.6 lakh applications with that entity. We are working in 15 countries with more than 3 client governments. So we see good growth coming in even in that company. We are now actively looking at bidding for multiple contracts in those jurisdictions from iData. So definitely, and we already started to combine some of our offices in the common territories. So we will see a good cost advantage, operational leverages, and the client governments that iData is working for. Now we are started bidding globally for them. If you talk about the digital business, in fact, we have actually seen an internal growth. What happened was last year, one of the contracts that we were running got completed. So those revenues have become zero from that contract. So that is why, in spite of the growth of banking correspondent and other e-governance business, in digital business, and from revenue point of view, you don't see any growth. But our other businesses have gone up. Definitely, having this acquisitions of RD Falaise and multiple new tenders coming in the digital business, we see good growth coming in future and even in that business.
Right. So I think strong outlook going ahead, and I think the street will be watching out for what's in store. Shikhar, thank you so much for joining us at NDTV Profit. Looking forward to speaking to you as well in the coming quarters. So that's BLS International. Clearly, if you see in terms of the stock price performance as well, a good up move. We are seeing some bit of a recovery from the day's lowest level, 0.3% higher as we speak. The day's highs has been around 403. It has cooled off slightly. But moving on, MedPlus Health Services. Let's quickly pull up the stock on the screens and see what the counter is doing in trade. 2.5% higher, slight cool off from the open. But if you see from a numbers perspective, 2.6 times is the up move that we've seen in terms of profitability. Margins have also improved substantially. One of the key reasons that we're picking up is the share of private labels has increased to 18.4% versus 14%. And the store level EBITDA margin has gone to 10.2% versus 9%. Gangadi Madhukar Reddy, the Managing Director and CEO at MedPlus Healthcare Services, joins in. Good afternoon, Mr. Reddy. Firstly, congratulations for the strong set of numbers. If you could help us understand, firstly, from a private label contribution, that has led to a limited top line growth, but a good margin growth. Is that going to be a strategy going ahead? And if so, what's the change in outlook do you have?
Sure. As with all retail, private label is one of the key drivers for margin, even in pharma retail. And I would say even more so in pharma retail, because this industry, the way it is set up, is actually something which can take private label to levels as high as 30, 40, or even 50%. That's the long-term goal. It could potentially do that, right? Right now, though, we are at around 17%, I think, by volume, if you look at it, in private label. And we expect that we will continue to grow this by at least 1% every quarter. And and I expect, while whatever growth we have gotten is, I would say the early kind of adopters and all, now on the growth is going to be at a slightly, I would say, muted level. It's around 1% every quarter, or maybe slightly more. But over a period of several quarters, I think we should be able to add significant margin to the EBITDA just by changing the product mix.
So just to reiterate, in terms of the change in product mix as well, to what level do you think will pharma come down to? Because from 72, you've already come down to 67, right? So what is that number going to look like?
You mean the branded pharma, right?
Yes.
Right. So branded pharma, well, we don't know how quickly the market will adopt and all. But as I said, the growth from now on is going to be slightly lesser than what it has been. We will probably add only 1%. So that means 1% decrease in the branded pharma for us every quarter. And every 1% typically adds around 15 basis points to the margin on the MRP side when you look at it. So I expect in a period of maybe 6 to 8 quarters, we should basically do that 8% odd and increase our overall EBITDA by at least 1.2%. So that's the on the margin side. If all of the things are held steady.
And as you're talking about the margin, your store level EBITDA margin has also increased 10.2% versus a 9, so it's double digit now. Is that something you will be able to maintain, or do you think it's just a one-off?
No. This is also a function of the overall gross margin. Gross has gone up, and that is not going to come down anyway. So it's going to remain steady. As I said, it can only go up over a period of time, albeit slowly. But I don't see any reason why it should actually come down.
Overall, earlier also you also mentioned in terms of the outlook with regards to private labels, where you at least want to grow 1% sequentially on private labels, right? How is that panning out? Are you on track going ahead as well?
Yeah. So over the last several quarters, we have done that anyway.
Correct.
We started last June in Telangana, and in October and November, we started across the country. And since then, it has actually grown pretty significantly. But as I said, in the last 2 quarters, we probably grew only around 1.5 or 1.5, 1.25% each. So, which basically means, okay, you're looking at the net sales here. I'm not talking about the net sales. See, private label, we measure in terms of the volume or on the MRP basis. The reason I say that is, if a regular product, whose MRP is 100 rupees, after a discount, we sell at 83. This one, after a discount of around 55%, we end up selling at 45. So when it replaces, the percentage which you actually see on the net sales is going to be lower. So when I said 1% growth, that was on the overall volume basis or on the MRP sale basis. So that remains true. So that 1% probably translates to around 0.5% or 0.6% on the net sales. But on the net sales, though, if you look at the margin, that is almost 50%. So it comes to the same thing, whether it is 15 basis points on a 1% growth, or whether it is, let us say, 50 basis points on a 0.6% growth, pretty much is, or slightly less, more or less the same numbers.
Right. Now
so for us, we expect we'll grow by around 1% on the MRP basis.
MRP basis. Now, if you have to look at FY25 as a year, a 20% growth guidance is what everyone is aiming at basis the con call, right? What is it that you're targeting now that you have the first half already been reported? Any changes there?
So given that, private label has taken on such a big portion of our overall business, and private label is margin accretive, but sometimes it does tend to basically reduce the overall top line, mainly because, as I said, what you would otherwise have sold at 83, now you're selling it at around 45. So I would say that the EBITDA is pretty much on target, if not on target even to beat what we expected. But on the top line, will probably be there year on year. And on the MRP basis, I think pretty easily, but I'm not so sure about the net sales.
Okay. How is the store addition part of it looking like going ahead? What's the trajectory? And how are you expected to fund the store expansion?
So we are cash flow positive. We don't have any debt at all.
Correct.
There's money in the bank. So for adding stores, I don't think that's a challenge. We had earlier guided to a 600 store growth this year, but it looks like it's going to be lesser. We will, in subsequent calls, probably be able to give some guidance on that. Stores, I think the net added stores have been around 145. The gross addition has been 198. We did shut down a few stores, I think. So if you take that the first half is 145, if you extrapolate, you'll probably get around 300. But I think we'll do slightly better because in the last quarter, we added 108. So even if we were to add at least that much more, it will probably be more. But the actual number will try and guide the investors in a later call, maybe this today.
Right. So I think lots that investors have to watch out for as well from here on, taking the growth trajectory into consideration. Thank you, Mr. Reddy, so much for joining us on the show clearly. So this is MedPlus. Let's quickly pull up a 6-month chart of MedPlus and see what the stock has done so far, because the expansion has been pretty much on track. In fact, some places they have surpassed what the street was anticipating as well. 2.6% higher in today's day of trade. Let's have a 6-month chart of the company. There you go, 6 months. It's been absolutely volatile. If you see, around 730 is the high that it's seen in the last 6 months as well. Now, whether the company would be on a track to recovery from here is what we need to wait and watch. So that's with regards to where MedPlus goes. But let's quickly pull up the markets right now because the fall continues to extend from where we opened up. If you see Nifty 50, we are nearly at the day's lowest levels, 0.9% lower, 200 points cut coming in. We are below the 23,700 mark already. All the sectors are on a decline. In fact, it's the broader markets which are crumbling as well right now. If you pull up the mid-cap 150 as well as the small-cap 250, there you go. Deeper cuts coming in there. Nearly a little over 400 points cut in terms of mid-cap and 430 points cut coming in terms of where the small-cap index is concerned as well. Let's pull up the PSU index because that's where the hit is. So you see the PSU bank index as well as the PSU index. Major cuts and extending losses over there. Nifty PSU bank is down almost 1.8%. And if you see the PSU index alone, not the PSU bank index, there you will see cuts as well. There you go, PSE 1.2% lower on that front. Stocks like M&M, Maruti Suzuki, Bajaj Auto and Hyundai, all of these, so that's the auto pack which has dropped as much as 5% in trade. In terms of the contributors, HDFC Bank, Reliance Industries, M&M, RIL, if you go to see from its peak is down almost 20-25%. So you can clearly say it is somewhere in its bear territory already. TCS is also under pressure. Only stock which is holding up right now is NTPC, seeing gains of around 5-5.5% somewhere. Trent, after the kind of fall, it's seeing some bit of buying interest that has come back in the last two sessions. Similar with Tata Motors as well, 2%, and Britannia, which is up around 0.7%. Let's quickly look up at the other stocks from the broader markets because let's see what they are doing in trade. So let's see which are the gainers in terms of broader markets as well. KNR Construction, a 7-8% up move coming in on that counter. Patel Engineering, Marksons Pharma, Suven Pharma, PPL Pharma. These so pharma names are holding up to some extent. That's Piramal Pharma. So these are few of the names which are holding up to gains. But on the losing end, you have names like a Suprajit, 11-12% lower on that counter. Greaves Cotton on the back of earnings is down 9.5%. Power India, Ratan India, all of these counters have been trading under pressure. So that's what it looks like. But moving on, keeping up with the earnings conversation, you have Orient Technologies that reported numbers as well. Overall, my colleague, if you see, did speak to the management because the revenues have jumped around 50%. Profits have surged 62%. However, the margins have remained flat. Rusha Somaya caught up with Ajay Sawant, who's the chairman and managing director at Orient Technologies, who spoke to us about the quarter gone by and the growth outlook going ahead. Let's listen in to a chunk of that conversation.
From an Orient perspective, we have done exceptionally well in Q2. Our revenue from operations has moved from 148.84 in Q1 to now 223.14 in Q2, which has shown growth of 49.36%. And if you compare this on year growth, it is coming out to be 49.92%, which is approximately 50% growth. From an EBITDA perspective, if you see, our Q1 was around 13.65%, vis-a-vis with in Q2 we have done 20.71%, which shows that the our year-on-year growth of around 47.63% and our Y-on-Y, if I have to see the numbers, it's around 50%. PAT growth, if you consider it, it's coming out to be around 62.54%, vis-a-vis on a Q numbers is around 62.20%. So exceptionally well results as far as the numbers goes. Secondly, we have declared 18% interim dividend for our investors, and I think we'll be doing really well in coming times as well.
Definitely, for sure. That's going to be great for the company, I bet. But let's move on to what kind of margins are we looking forward to? Currently at around 9.3% on a quarter-on-quarter basis. But what kind of, say, short-term target can an investor expect for FY25 in terms of margins?
So in FY25, we are planning to get into a double-digit percentage margin. Currently, we are working on towards it. We have to get into more of operational efficiency in this, and next 4-5 months we'll be working on that, and hopefully we'll be touching somewhere into 9.5 to 10% within that range.
9.5% for FY25, and what could be the potential levers for this?
So ideally, it should be the operational efficiency.
Okay, operational efficiency. Okay, got that. Let's move on to the segmental revenue split. While we have almost 52% of your revenue coming from the mid markets, which largely includes real estate, infrastructure, logistics, etc. And then, followed by BFSI, government and PSU, just to give our viewers a kind of brief outlook over here. What kind of growth do you expect in terms of each geography for FY25, and which one will be the best performing one for FY25?
In FY25, I feel the SMB or the mid-market will continue to grow. So that's the business model which is contributing towards more than half of our business, and it's going to grow. But we are also targeting government and PSUs along with the BFSI. So BFSI is the major focus along with government and PSU after SMB, of course, or the mid-market that we call it.
What kind of margins are there in terms of mid-market and BFSI currently? If you can give us a range.
Currently, the mid-market is giving us a double-digit percentage EBITDA, whereas BFSI and government is slightly pulling it down to around 8 to 9%. Which is averaging it around 9.3% as of H1. H2, we are trying to improve on that, but that's where the business model will keep on evolving, and we'll be focusing more and more on BFSI to increase our margins and the revenue perspective.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Markets follow global cues as benchmarks trade in red, with Nifty trading flat and Sensex losing close to 1%. All sectors in a sea of red. Realty, metals, media lead the losses. And it's arrived. Zomato's key competitor Swiggy shares rally after listing at an 8% premium over IPO price at 420 rupees on NSE. Voting is underway today for the first phase of the Jharkhand Assembly elections, where 43 out of the state's 81 seats across 15 districts are up for grabs. As of 11 a.m., the voter turnout was 29.3%. The Supreme Court issues a stern warning on bulldozer justice, declaring that demolishing the homes of accused individuals without judicial verification is unlawful. Hello and welcome. You're watching Market IQ. Good afternoon. I am Malika Mishra. Before we begin with the show, let's take a quick look at the markets first. The benchmarks Both NSE Nifty 50 and BSE Sensex are trading with deep cuts today following global cues. As you can see on your screen, the Nifty 50 is down by 0.98%, trading around 23,600 levels, while Sensex, on the other hand, is low as well, trading around 78,000 levels, again 0.8%, over 0.8% down. Speaking of the broader markets, both Nifty Midcap 150, as you will see on your screen, and Nifty Small Cap 250 are down over 2%, underperforming the benchmarks. The volatility index has spiked over 4%. Now, let's also take a look at the Nifty contributors. And as you will see, heavyweights like HDFC, RIL, M&M, TCS are dragging down the markets. RIL is dragging down the markets by 26 points, followed by HDFC at 25, M&M at 20, TCS at 30. Then there's NTPC, Tata Motors, Trent and Britannia marginally moving up the market, sort of adding relief to the pressure. NTPC is up on the back of Macquarie initiating coverage on the stock. Now, also, let's take a look at what's dragging down and what's dragging up the market. The street right now looks a little like the street right now is in the red, is in a sea of red. Let's also pull up the top losers and top gainers in trade today. Stocks like NTPC, as I said before, is over 1% up. Then there's Trent, which is 0.28% up. Tata Motors is 0.26% up. Britannia, M&M, Voltas, anywhere between 0.25 and 0.27% up. Let's also take a look at the top losers today, and you will see that a large pack of the auto space, like a lot of stocks from the auto space, are in the red. Hindalco, Eicher, M&M, Hindalco is down over 4%. Then there's Hero Moto, Tata Steel, JSW, again, anywhere between 3.5 to 2.5% down. There is BEL, BAIL, Bajaj Auto, Apollo Hospitals, again, over 2% down in trade. We'll also look at how the market breadth looks like right now. And you would see on your screen that market breadth looks heavily skewed, mostly in favor of declines, with less than a quarter of the stocks in the green zone, right? There are just 202 stocks advancing, while 1,934 stocks declining. That's a huge gap between the stocks that are gaining and declining in trade today. Let's also take a look at the sectoral indices, and the street appears extremely bearish, with realty, metal, auto, media, PSU, oil and gas adding most pressure to the market. As you can see, it's a sea of red. India Wix totally actually reflects the market condition right now. Volatility is up over about 5%. We'll move on with the show right now. Man Industries reported a weak set of second quarter results, with profit dropping by over 18%, while the revenue fell by 21%. We spoke to Nikhil Mansukhani, Managing Director at Man Industries, to understand what led to the decline in net profit and the quarter gone by.
Compared to last year, it was the total top line is slightly lower in this quarter. But in our business, actually, we don't comparatively look at quarter to quarter, because we give a complete outlook of the year. The outlook of the year this year also, we should be growing around 15 to 20%. And this quarter, approximately, the margins are better. The EBITDA margins are 9% on a console level, higher than 9%. And the PAT margin regions are quite similar to what we achieved last year. Last year, similar time, a lot of the shipments were going and export orders were going on. That's why that particular quarter was done quite well. But looking at the overall outlook of the year, the next two quarters are also very positive for the company. And we are within the reach of the guidance which we have given.
Well, that's fair enough. You mentioned about margins. There was an improvement that has taken place. Overall, if you look at your FY25 guidance is also, that is about 10%. And you expect this to go further to 13% by FY26. So talk to us about what are the kind of operational levers which are in place that is leading to this kind of margin expansion that you're looking at for the next 2 to 3 years.
So basically, yes, this year the guidance, we would be reaching between 10 to 11% of EBITDA by the end of the year. Going forward, 26, 27, we are looking for a more healthy turnover with our subsidiaries such as Saudi and SS coming into foray and starting. So definitely the same staff, everyone is same at the HO. Our cost is divided once the turnover goes up, and that would obviously in turn increase our EBITDA margins. So 26, 27, we are definitely looking at a much healthier EBITDA margin between 11 to 13%, and we are confident that we'll be achieving that.
So while 15 to 20% is the growth outlook that you're giving for FY25, what is the kind of revenue growth, the incremental revenues that you expect with the new capacities coming in picture from FY26 onwards?
So FY26, in the revenue growth itself, we are looking at around 30% jump, 30 to 40% jump in 2026. And, when those new units are stabilized, we are looking at approximately $1 billion of total top line revenue by 27 and 28, once both the new units are stabilized.
All right, so 30% is the number that one should be looking out from FY26 onwards. Now coming to your order book, the order book stood at about 3,100 crore. This also included a very big ticket size order of about 1,800 in this first half. Can you explain, going forward in H2 or even FY26, is the plan to capture more of these big ticket size orders, and would that be the domestic or more in the international market? If you can give an outlook on that.
So I think the big ticket size projects are there in India as well as abroad. But I think the oil and gas industry is booming, and that's how we are doing larger export orders. Currently, we are already bidding for quite a lot of large export orders, and that's going to be pretty much the trend going forward as well. Even this year, we will be 80% exports and 20% domestic. And so definitely larger orders of the scale that we've already got, we're already bidding for those. And hopefully we should be getting something for the next year and the year coming forward.
Okay, so 80% from domestic and 20% from international, that is what we are looking at for.
International, sorry, and 20% domestic.
Okay, 20.
Yeah.
Okay, so considering that, I want to understand what is the kind of order pipeline opportunity that we are looking at, and what usually for Man Industries is the success ratio that you convert from these pipeline opportunities that we are looking at for the projects that you're bidding.
Correct. So currently the bid book would be around 13,000 odd crores. And it's quite a robust bid books because you keep putting in the bids with the new orders which are coming in. And around 20 to 30% is our success ratio. It also depends a lot of times on how aggressive we go on certain orders, because we also have our qualifications, which we want to be there. Certain places we want to take orders because we want to be present in those countries. So definitely the bid book is increasing. We are getting more and more qualified. Recently, we got qualified for Shell as well. So more and more places that we're getting qualified and bidding, our bid book is increasing. And accordingly, obviously, the turnover and everything of the company would also be increasing.
All right, that's fair to understand. Now, moving on to the next question, I want to understand what is the progress that we're looking at with some of the capacity expansions. You talked about Saudi Arabia, there's one in Jammu. Can you expand on what's the progress there, and what are the Capex plans that we have for FY25? Are we looking at a change in the Capex number for this year? And also, if you can give us a perspective on the next year's Capex number.
Yeah. So both the projects are going on quite swiftly. We should be under operation in Saudi Arabia by August 2026. And by August 2026, also the Jammu unit should be in operation. Capex plan are no further expansion plan as yet because we want to complete this Capex, stabilize this, and then we would be further, planning our Capex and the strategy of investments. So currently, both the projects, which would, be able to give a top line of almost $500 million, are on progress and should be achieved by probably third quarter next year, like I discussed.
Apollo Hospitals announced fairly constructive Q2 results. Consolidated net profit surged by 63% to 379 crore, driven by higher demand for its healthcare services. We spoke to Aditya Khemka from Incred Asset Management if the nature of growth would take care of high stock valuations. Listen to what he had to say.
If you look at hospital stocks, especially if you look at Apollo stock price history, right? Let history tell you what will happen in future. So Apollo has had, or these hospital stocks do have 3-4 year periods when there is zero return, whereas the business continues to grow. Now that happens because the multiples in the period prior to those 3-4 years would have been taken to a level where the multiple just cannot re-rate any further. And therefore the business has to grow and compensate for the multiple to come down over a period of time till it becomes affordable. And then again, the next leg of stock performance comes. So I'm very, very sure Apollo will do a great job as a company in terms of growth in top line, EBITDA and bottom line and cash flows. But in terms of the multiples, I think, a lot of that growth is getting discounted in the current stock price.
Swiggy made its market debut today, listing with a nearly 8% premium on the National Stock Exchange and 5.6% on the BSE. Swiggy's initial public offering was valued at 11,327 crore rupees. The IPO saw muted demand, closing at 3.59 times subscription, driven largely by institutional investors. Listen in to what the founders had to say post-listing about competing with their listed peers.
The answers for all of these are going to be who takes more care of their consumers, who's innovating on behalf of consumers, and that's exactly what our plan will be. To understand, latent needs, to understand expressed needs, to solve for needs that even consumers didn't know they had. I think all of this is going to be important as we think about just really, really strong growth in the category, and that's what we're gunning for over the next few years.
NDTV Profit's Charu Singh spoke to Ashutosh Sharma, the India investment head at Process, to find out if the investor is planning to sell any more shares in the company.
This is a very important milestone for both Swiggy and Process. For Process, it's a validation of our investment thesis on India. It's a validation of our investment thesis on food delivery. We've made some nice returns on these investments. We are taking some money off the table, but we continue to be the largest shareholders, as you said, Shub.
Although you said that you continue to be the largest shareholder, but you are planning on sharing, selling off some of the shares. Is there a reason why?
Not anymore. So we already sold in the IPO and we don't plan to sell anymore.
No further disinvestment, basically.
No.
So what do you think is, the psyche of the other shareholders in Swiggy currently? Is everybody happy?
Oh, I'm sure people are very excited. It's been a long journey. Harsha has been an amazing founder. And some of us have been on the cap table for a very long time. And I can see that excitement, general excitement amongst the shareholders for sure.
On to some election coverage now. 43 of Jharkhand's 81 assembly seats are voting in the first phase of election. A handful of by-elections are also taking place, the most prominent of which is Priyanka Gandhi Vadra's test in Kerala's Wayanad. In the first phase of the Jharkhand assembly elections, voting across 15 districts of the state's 81-seat assembly is underway. Key candidates today include former Chief Minister Champai Soren and his son Babulal Soren, former Chief Minister Arjun Munda's wife Meera Munda, Madhu Koda's wife Geeta Koda and Raghuvar Das' daughter-in-law Purnima Sahu. NDTV's Prabhakar Kumar joins in with the latest updates.
Yeah, the first phase of polling in Jharkhand is underway. 43 assembly constituencies going to poll today, and very crucial for both India Bloc and NDA Alliance, because most of these constituencies which are going to poll today, they are tribal-dominated constituencies, and we have seen in past how for last 10-15 days BJP is trying to build a narrative around the tribal vote bank, because tribals are an important vote chunk out here, and they are the decisive voters as far as the Jharkhand is concerned. So we have seen BJP talking about the Bangladeshi infiltration, talking about how those illegal immigrants are settling down here with the help of the JMM and the Congress combined, and how that is actually helping out those people eat into the resources of tribals. So that is in a way to lure and send out a message to tribal voters that the JMM is actually not helping their cause. Now, apart from the tribal voters, they have been talking about the women voters, the kind of freebies given to women, whether it is Maiya Samman Yojana or Gogo Didi Yojana, where the stipend to women voters have been increased from 1,000 rupees to 2,100 rupees by BJP, and the JMM later went on to add further 400 rupees into it, and has promised that if it is voted back to power, it would be enhanced to 2,500 rupees. Also, the waiver of the registry fee if any property is registered in the name of women voters. So these three main segments, three main chunks actually of voters which are being